big tech having a little bit of trouble. Talked about those regulations and scrutiny coming from China and the EU, maybe keeping a little bit of a lid on some of the tech stocks today, but just generally a little softness in stocks to start things off. Can't really blame bonds or the dollar, not much action there, but the dollar is kind of firming up as risk comes off this morning. And a lot of the stocks we're going to talk about here over the next 15 minutes are fairly mixed. Nothing obviously leading this market right now. And earnings, which we'll talk about with Zscaler, not offering a hero for tech there as that stock's down. Right now, let's bring in Carolyn Woods and let's talk about maybe some of the ramifications of higher oil prices with airlines. But what's interesting is we got an upgrade and we got a downgrade, and it's from the same team. And so I guess they're telling us at BNP there are going to be winners and losers in the sector. I'm interested to hear the details, Caroline, because American got the upgrade, and a lot of times that's the stock that people keep a distance from, given the debt and all that.
Well, Oliver, it's been a mixed picture really all year for airline stocks, and it seems to be the case today as well. We're seeing red and green arrows across the board. Didn't just see analyst activity. We actually saw some of these airlines updating their guidance, flagging rising fuel costs, talking about some softer August activity. So definitely a mixed picture today. But let's start by talking about Southwest, which is quite a bit lower today, off about almost 2%. Southwest actually narrowed its third quarter revenue per available seat mile outlook to the downside, expecting a bigger drop on the lower end, and said last minute leisure bookings softened in August as seasonal trends returned. The airline now expects third quarter revenue per available seat mile to fall by 5 to 7%. The previous guidance range was for a drop of 3 to 7%. So increasing the lower end of that to 5% decline. Southwest also raised its guidance for fuel costs to $2.70 a gallon to $2.80 a gallon. Previously, it was $2.55 to $2.65 a gallon. But the company did say, despite August bookings being on the lower end of expectations, overall leisure demand and yields continue to remain healthy. Travel demand during Labor Day weekend was strong, produced record revenue performance for the holiday weekend, and business travel trends have performed in line with expectations. But you mentioned the BNP move. Did get a downgrade from BNP Paribas to neutral from outperform with a $34 price target. So Southwest currently trading around $30.51, so about $3.50 upside from here. Meanwhile, BNP Paribas upgraded American Airlines to outperform from neutral with a $20 price target. It's actually higher today, up about 1.3% in the early going, trading around $14.50. So about $5.50 upside, according to BNP Paribas. And then I'm also taking a look at United today. United shares actually started lower, but now up about 1%. Did raise its third quarter fuel price outlook, citing a 20% jump in fuel costs since mid-July. Now expects fuel costs of $2.95 to $3.05 a gallon for the current quarter, up from its previous guidance of $2.50 to $2.80. But that didn't impact its third quarter guidance. It reiterated its third quarter outlook, expects revenue to rise 10 to 13% from a year ago, expects capacity to be up about 16%, and it didn't provide an update on earnings per share, but previously back in July it said it expected $3.85 to $4.35 per share. Should also note Alaska Airlines is higher today as well, up about 0.8%, but they did warn that higher fuel costs will hit margins, and now forecasting pre-tax margins of 10 to 12%, down from 14 to 16%. And they expect Q3 revenue to rise between 1 and 2% year over year. The previous range was 0 to 3% because of some of those canceled because of some of the canceled flights because of the wildfires in Maui. So tightened that guidance range, but doesn't have seem to be having an impact on shares today. And then also, of course, Delta shares up about 1.3% on the heels of, I don't know if you saw it, announced a strategic partnership, multi-year partnership with Tom Brady. He's going to become a strategic advisor over at Delta. So from Super Bowl champ to airline executive. Interesting move.
Yeah, and car rental guru as well. So seems like, unsurprisingly, he's in pretty strong demand. Sure, he's not going to have any trouble pulling in a paycheck. Guess he's on the move, traveling, okay. All right, pretty interesting.
Probably taking more flights than rental cars, I would say.
Yeah, but apparently someone found his receipt in a rental car over the weekend, which is kind of funny. He tweeted out, see, I told you guys I actually use Hertz, right? Yeah, Hertz. All right, so, hey, the market seems like it's fine with this. I mean, love is a little bit sluggish, Southwest there, but everything else higher. American appreciating this note from the analyst up 2.25%. Fuel's going to maybe get in the way of some of it, but they've demonstrated they can pass a good bit of this on to the consumer. So I guess as long as the economy doesn't slow down, then most of these airlines should at least have some floor under their stock, you would think.
And Oliver, I should note that even Southwest, which was the biggest loser when the market opened, 7 minutes ago, is now only down about 0.3% despite the downgrade and despite the soft August bookings. So it seems like these stocks are going to be resilient today.
Okay, thanks, Caroline Woods. Coming to us from the New York Stock Exchange with the airline scoop. Let's bring in Jeff Pierce in the Midwest with the tech scoop. Our senior manager of derivatives trading, Charles Schwab. Morning, Jeff. Hey, Zscaler is really the only major earnings to think about before a few tonight. Shares are down. Reports seemed okay. What I missed there?
Yeah, I thought the report looked relatively good as well, though, as you pointed out, down just about 3% now. Earnings per share did beat, coming in at 64 cents versus the 49 cents expected. That's up from 25 cents last year. Revenue beat as well, 455.01 million versus just over 430 million that was expected, up 43% year over year. If we look at the calculated billing side, that grew 38% year over year. Deferred revenue was up 41%. Zscaler also said they doubled their annual recurring revenue in less than 2 years. Cash flow from operations came in at 135.9 million. That's up from just over 103 last year. On the the outlook side, we saw Q1 earnings per share expectations of 48 to 49 cents. Analysts were mainly looking around 45 cents. Revenue 472 million to 474 million. Analysts were looking for around 464. On the full year outlook, on the revenue side, looking for 2.05 to 2.065. That's versus estimates of about 2.04. I think where we're seeing some reaction here is the company commentary, right? The company did talk a little bit about executing well in this macro environment, but they see challenges remaining. They said, the global macro environment remains uncertain. They added that the growing economic uncertainty, they are mindful of this environment, and that closing deals within 90 days remains challenging. They said from their perspective, the global macro remains uncertain and customers continue to scrutinize large deals. Unfortunately, this isn't a new story coming out of Zscaler. We've heard this earlier in the year as well.
Okay. So the outlook, I think, is at this point, pretty good. It's certainly, better than what we've seen from a lot of companies that are unable to really raise it up in the cloud sector right now, in the security side. There's an employment connection here, too, in a big way when the economy is stable and folks aren't laying people off. Because for every work computer, you got a Zscaler login, basically, if you're using their security entryway, their portal, et cetera. So I think that the group kind of trades pretty similarly, so we want to hear what happens after the big run they got in the first half of this year. Some of these have been going a little sideways around this earnings, and it's not because the earnings have been bad. I'm thinking about like a Palo Alto too. Basically sideways for the last month, really choppy on earnings. CrowdStrike looks just like Zscaler, where they're trying really to push to fresh new highs. Here's the ETF that tracks cybersecurity. That's doing quite well. I think there might be a little chip impact there. But I think, you have to be at least satisfied if you're a big cloud growth textile investor that these earnings didn't bomb.
Yeah, absolutely. I mean, while you're looking at a company, this is, they beat the bottom and top and bottom line numbers here for 20 straight quarters. So investors are expecting a decent report coming out of a company like this. But as you pointed out, and we've talked about a lot, tech has had scrutiny, especially on the IT side, and that's something that we continue to see investors concerned about. Now on the side in the security space, we've seen, a little bit more leeway there, but we're still not seeing these large subscription commitments to some of these companies. And I think that that's where we're seeing a little bit of pullback as companies they're coming out with an honest opinion that there may be a little bit of softness. And to your point, we've got, hiring maybe not as quick as what we've seen over the last couple of years. We're going to continue to see, companies kind of hedge their bets a little bit with this commentary.
Okay. There's that chart for Zscaler trying to break out to fresh year-to-date highs. By the way, that hack ETF, which is crushing it right now, a lot of Splunk in there, which has done very well. I guess Splunk is the real leader. Cisco as well. Akamai has done quite well. Splunk, relative to all the other ones as far as security and software goes, I mean, seems like that's the leader at this point with the major breakout. So, all right, we'll watch the group. It's a little bit mixed today. NASDAQ down a little bit. Some of the tech stuff kind of mixed, but big tech is more the problem right now with Apple, Tesla down. Some of these mid-cap, high-growth companies looking pretty encouraging, gotta say. And Hack ETF doing a really nice job capturing this recovery in cyber, but still a long ways to go. $68 high for that fund. We're at 53 right now. How about Roku and the layoffs, Jeff?
Good morning.
Yeah, we've got Roku saying that they're going to reduce their workforce by around 10% and
August 6th is the day of today. We're going to be streaming stocks, options, futures trading. We're looking at SPY, Barbecue, GME, AMC, Bed Bath & Beyond, GNS. Looks like we got Weeze, little gap up. Express had good earnings. Sub up, like up, comment down. Happy Money sticks around. You can follow us on Twitter at Happy Money YT. And we have Discord server you can join. Link for those are in the description. Bit of a gap down here on SPY. Making its way back up. Stays down 0.25%. Oh yeah, Discord link, guys. All the bots can join. Guys, have a good morning. Rest of your evening. Short week. Bubba. Delicious. Morning, Guts. Aloha, Maui. Here we go. Hey, kitty. Hey, Lords. For 6th. Alright, September. Did I say August? That is true. AMC dumped this morning. Dilution 40 million shares, which prior to the reverse split, that wouldn't have been anything. But now that's almost like 8% of the float. So technically you could say it should only sell off 8%, I guess. But here we are, down 20%. I think they were only expecting, I think said in Discord they were expecting less dilution at this point. So there is that. Grab a couple puts there at high of the day. Market high. These might be real quick. Real quick. Close one for some profit, then we'll put a stop loss and the rest for break even. Lock in some. like doing it that way. Take a little profit and then leave the rest. Back down to VWAP here. AMC's down almost 20%. Back to its, yeah, back to that low. First split low. Barbecue came down a little bit, but bounced right on our trend line. Good to see it stay above there at least. I'll probably be closing out if we drop below this. Need to see it get more bullish. Doing idle. Yeah, GNS had that fickle move yesterday, down back 8.5%. GME is down 2.25. Look at that, just below this, staying below this trend line. I had to do a couple puts in there. Still same deal. Moved, so averaged up on them. Moved my stop, which could very well get triggered this morning. It could be continuation day though. Had chop for the last 3 days as it's kind of rolled over. Now I think we'll see some continuation. I'm leaning to the downside, but could be a continuation of the downside and then a reversal and a bounce by end of day, or the other way around. But something outside of a choppy range I think is warranted since we're below the support, kind of in a free fall area. Barbecue's down 5%. AMC still selling 20.5%. Wonder if it's the final death of this stock. Sure seems like it. Been a long time coming. I got stopped out of those contracts. Let's just hop around here a little bit. Usually when AMC's had pretty big dumps, there's been a pretty quick reversal. Bit of chop this morning. Bubba's in heavy. 447 puts. Yeah, I think we could get. If we do, if our bullshit, I think we might have a. I think we could come down a little further first. 446, 32. Find maybe that for support before we start heading back up. There's a gap there now too. Look at that. Might want to fill that gap first, even. I don't really know. We broke the lows, haven't broken the highs. GME down 2.6, Express up 20%. Got WeWork up 5.5. Just had a reverse split. Confluence up 4. Datadog up 1/4. Chewy's up 3. Bonds up 3. Minty up 4.5. Back to VWAP. Undecided still. Barbecue bounced there a bit, only down 1.8, 2360. Me down 2.8. AMC down 20%. Hawaiian's down 1%. Set stopped -99%. Ultra bear flag. Ultra domination. I feel like I'm playing Unreal Tournament whenever I hear your trades, Bubba. we had trade deficit this morning, 8:30. Bostic was speaking, no, Collins was speaking, and then services PMI at 9:45, so that's part of the chop, and then ISM services coming out in 40 seconds. We might see a move from that. Then you have beige book today at 2. So markets may be waiting on that. Chopping. Front of it. There's the ISM manufacturing. Market didn't like it, I guess. Here's your dump from it. We got 446. That's close to that level. Close to that next support. Close any puts, Bubba? GME down 3. 1865. AMC maybe flattening out here. Back at that same low. $10 might be the new support. Rises 54.7 from 50.7. Bad news is still good news for the market. Grab some puts. Close some at this support here. Dish down 2.6. Radis had no relief. Just a slight rally and that was it. All over. monthly low there on SPY. 44651. It's down 0.6% now. Close one of these. Close 30%. Smaller position in the morning here. Yeah, close the rest actually. Let's reload here. We'll see. I got it on a poor entry. Barbecue 23.49 down 2.3. Maybe flattening out there a bit. AMC 20.5. Nice, bud. Well done, man. Way to not just hold till they expire worthless. Market's just kind of consolidating down here. Let's see what we got. We've got a shoulder and a head for an inverse head and shoulders if we come back up and start to build some liquidity on this right shoulder. Or we could back up and kind of reject there and continue this down channel. And break through this support. Good. ways to go. GNS down 7.5. Barbecue down 5. I might be kind of breaking out of this bear flag. Back in. 145 puts. Got my button on the calls. But yeah, the way it's kind of flagging. Flags don't. They're not. Yeah, I like them, but they usually can just reverse on you. Less probable than a Head and Shoulders. That VWAP. Well, we've got an RSI divergence there. Bullish. This level holds. Got a few calls. Might head further down, but I think we'll probably make a little bump back up here first. In the meantime, put a tight stop on these. Oh, you're using cash count now? Nice, yeah. Yeah, you just kind of have to watch your buying power as it dwindles away. But you don't trade that much during the day, so probably fine. My goodness. Healthy diet you got going there, Bubblicious. Little bounce. Let's see if we can get to VWAP. Oh, ABCD pattern on the fibs. Could be. See if it rejects this right shoulder. Makes it that high, of course. Jacko Goomba on the puts. Stopped out on those calls. I don't give myself much headroom. So I'm a little up on the day. So I just have them on break even. Sit on them for a little bit, and then if they go on my favor, I'll throw a break even trade on it. GME down 2.5. Bounce off the bottom there. Prices come down some. It's up 12.5 now. Got Marin ripping 43%. No idea what that's from. New low of the day there on SPY. Let's see. There's that support potentially. Lies down 0.61. Barbecue 4.3. Give me 2.5. 19.5. And 30. Nice, Jack. Well done, man. Lows there on SPY. Got a bit of a vacuum down here. GME kind of flushed down with that SPY move, down 3% now. Barbecue holding at 4.24. SPY's down a little more. If you get a bounce, maybe for a re-entry. Swap's pretty low. Switch to digital currency in December. Haven't heard any specific dates for that. Vickers down 7.7. Actually flattening out here though. HE down 3.9. I might be going for that gap fill. See, holding it down 20%. Beyond is down 2.5. Engulfing candle there? Oh, not quite. Carvana has held up so well. Holodoc's down 1%. AI has earnings after hours. So We is halted. Halted to the upside.
Profile really does a good job of taking a cross section of the past year and highlighting the way these big rallies up to the highs keep fading. So the volume almost directly increases the lower you go, and it looks like it's like a pull, a gravity almost on the stock back to that 35 bucks. The good news, the kind of flip side of that coin, is that it would be very well supported down here. So it doesn't seem like there's reason to be like deeply bearish on the chart, but you do kind of need the earnings to show up here to hold this gap. Otherwise, there's a pretty good reason for it to come back and close that gap and go back to the area of highest volume.
It's always worth keeping an eye on those gaps. It's uncanny how they can be filled sometimes.
Yeah.
Certainly doesn't happen every time, but it's something that experienced traders often keep an eye on.
Okay, all right. Last one, GameStop today. And obviously the king of the meme stocks, and the last couple of earnings have not been great. Real lack of direction, it seems, still from their strategy side. What are we looking for here, Renita?
Quick note on Dave & Buster's. Looks like they decided against pickleball. However, they do have the axe thrown. Right, not enough space. But GameStop, this is going to be the first time that GameStop reports after its CEO was fired and after its CFO had resigned. Now, we didn't really get a reason why the CEO was fired as well. The company also did not hold an earnings call last quarter, but the video game industry, while it's growing, it's shifting more digital, which leaves GameStop in the dust because it is not shifting more digital. The best thing GameStop has going for it is its collectibles category, and we'll find out how that's growing. But this company has not made significant moves to bring its business into this generation. It's been struggling to post consistent profit over the past 3 years, and it hasn't given guidance in several years. But we're looking for an adjusted loss of 15 cents a share on revenue of $1.14 billion. One thing that the company has going for it is its humongous pile of net cash of around $1.3 billion, and Wedbush Securities notes that it should keep the company afloat while it figures out other streams of income.
I like the way the B-roll's showing us the stores that actually have the playable devices in them, and like none of them really even have that anymore.
Right.
Losing a ton of money on the bottom line, maybe some cash still to put to work here. It's just where to do it and where they're going to get the biggest bang for their buck. The collectibles, you know, people have gone in just buying those there at the store. It's like a convenience store for Funko dolls and magazines and anime posters and stuff. So I don't know if that's going to cut it, but some slight, like the slightest hope in this chart, Rick?
Well, there's always hope, but
this is like uptrending.
we used to say, there used to be a saying written down on a whiteboard when I was on the other side of the office: hope is a terrible hedge. So keep that in mind as we talk about hope.
It's not a strategy.
But you're right, though. It is a very modest uptrend, climbing off those yearly lows here. And you want to talk about hope. We did break through this downward sloping trend line just yesterday. We pushed above our yellow 21-day exponential moving average, but we've been rejected at that point. We're slipping back below it here.
He's got my same line.
Remaining above our old trend line.
We is resumed.
In the middle of these two indicators here.
Ripping.
We got to wait and see what happens after we get these earnings for some more directional cues here, because I wouldn't put a ton of stock into a breakout that's happening right before earnings. There's a big event risk that's happening. It could really change things here. But overall, not looking too great here. As I said, we are making higher lows, but we topped out at this red dashed line here near the 27 mark. We had a double top that formed there after our earnings from back in March. And then our earnings once again in May. So earnings is definitely a catalyst for this name. You can see the gaps that form on this chart here. But we're a long way off from the point that we would need to break above to really resume some kind of bigger uptrend here. You can see our moving averages sloping downward here. RSI still in the bearish side of the camp. We did break out of the oversold area, which is a bullish signal here, but we'd want to break above that 50 midline as well to resume bullish momentum. So we can see as well there's a few volume nodes here around 18 and around 21 or so around these points. And then we've got our volume profile point of control around 23. So like we talked about with our last stock, look for price to be drawn to these areas. These are areas of heavy trading, places where traders have shown conviction. So they can also be support and resistance areas. And our profile, our volume profile point of control lines up pretty closely with our 252-day EMA as well. So that's the kind of thing you want to look for when multiple things line up.
In this case, the actual volume concentration of that volume profile is a positive for the stock, maybe drawing it kind of higher towards the middle of the chart, because it is certainly down at the lows. And last time we were at the lows going into earnings, we bounced because the previous earnings we got last quarter, we were actually at the highs, put in the high. So, you know, back here too, we were higher and we dropped. So maybe there's some hope that some of the weakness of fundamentally of this company has sort of already been priced in. Maybe already considered with the stock trading so weak over the past 2 months with a big drop off. Thanks, Rick, for the perspective. Renita on the numbers. When we come back,
that last earnings wrong. Last earnings we gapped down and then it rallied from
but not tech,
Owen
AI,
buying
computer.
and Chang. Who's on rework?
coming in ahead of that as well. Full year adjusted earnings are now expected to be $2.30 to $2.60 per share. The expectations for $2.60, so coming in line with the high end of that range. Also, Baird upgraded shares of AeroVironment to outperform from neutral, raised its price target from $95 to $128 following these results. So AeroVironment currently trading around $122. So despite this a 30% move higher today, Baird still sees a couple dollars upside from here. Also, RBC Capital maintained its outperform rating on shares and boosted its price target to $120. So now currently trading above that level. But I will say that Baird analyst was one of the few holdouts on the street. There's only 7 analysts that cover this company. Now 6 have a buy rating, and there's 1 hold. So it was one of 2 holds previously. The median price target, $117.50. But I was, not familiar with this company at all. Should note, ticker symbol AVAV. Was looking on their website just to kind of get a better sense of what they do. And they say whether they're warfighters searching for an enemy, border patrol agents searching for people in need of assistance, or telecom providers linking millions to the digital economy, our customers choose AeroVironment because our systems generate actionable intelligence reliably, creating a path to goals that would otherwise be unattainable. So basically give a different view than what you can see on the ground.
Cool company, cool stock. Cool tech, seems like. So right now, the limited analyst community also kind of seems like a little selection bias maybe when pretty much all of them are liking the stock, saying to buy it. And it looks like
consolidating down here, though. Probably setting up for a move back up.
The fact that they like it, so they're going to cover it. But I think there's something to it, probably. I mean, it looks like it's pretty legit, and shares going berserk. So, we're not getting a whole lot of that right now.
Well, the analysts say now that it's up about 42% year to date.
Yeah,
will they still say to buy it, or will they scale back those expectations?
Exactly. Well, history tells us anything. Analysts
tend
to chase the price as it goes up. So right now it's going up. Thanks, Caroline.
Down a little more.
Environment, unmanned aircraft tech. All right, cool. We do have a manned meetup panel. George Tillis and Scott Durfee with me here this morning. As markets come under a little bit of pressure, Scott, it does seem like our hot ISM services kind of threw us off a little bit earlier this morning.
Yeah, there's no doubt about it. We haven't seen a hot number like that since we can go back to January, since we've seen those kind of ISM numbers, right? And when we see an ISM number that's above 50, that's an indication that we are expanding. And so, since January to now, we've seen sort of a contraction in that. Now we're seeing the beginning of, we'll see if it holds out. I think it will. But we're beginning to see the expansion now of the service manufacturing. And, I think that it did throw us a bit of a curveball. September, though, true to its reputation, we're already seeing some beginning of what could be a tough month for stocks. But, there's a lot of good things that could potentially be happening. And as we see more data, more things start to come out, we'll see if the September kind of idea or the feeling around the stock market in September kind of capitulates. We're off to a bit of a rocky start with crude and a few other things that have been putting pressure on the stock market itself. But let's see what happens over time. Again, great number. ISM, haven't seen those kind of numbers since January.
Yeah, it's pretty wild to get.
I don't think it's sort of out of the ordinary. I think it's just part and parcel of what we're seeing. I mean, the economy's still expanding. I think the ISM numbers reflect that. I think services is still strong. I think manufacturing is still strong. The economy is still strong. At the end of the day, we can't really look at the economy as bad unless the unemployment rate starts to trend to the upside. I know that we got a little bit higher of a print last week, but that's to be expected considering the fact that more people are entering the workforce. So at the end of the day, as long as the labor market is expanding, productivity is expanding, the economy will be expanding. And again, I'm not surprised to see it. I think at the end of the day, from a market standpoint, at least the equities, I think we're in a transition. And what I mean by that is if you just look at the daily volatility, you don't really see what's going on an intraday basis, but there's a lot of intraday volatility. I think we're in a distribution stage where individual investors or traders are actually selling the rips versus buying the dips right now. And again, after a 3-week pullback, we saw a little bit of an upswing in the last 2 weeks. And I think we're going to see a lot of volatility, as Scott alludes to, continue throughout this month. And again, looking at the dollar, it's breaking back above its 50-week moving average. I think there's inflation creep still going on, especially in food. When you go shopping at the grocery store, unless the store that I shop at mostly is just increasing prices, all else equal, no one else is.
Food has continued to go up.
Still a problem, especially when it comes to food, and I think that's going to be a problem from a discretionary standpoint at the household level.
Yeah,
big problem.
Potential for heat up in inflation seems to be now the top concern, but one could argue a better thing to be concerned about than a deep recession. Fair enough, Scott?
Yeah, there's no doubt about it. But George is 100% accurate. All of this news is going to be great, but inflation, we have got to see prices begin to dip. Until we see that, then we're kind of in the same boat, and the net effect that we're having will kind of remain here. So absolutely, but George is 100% right. When you go to the grocery store, if we keep seeing prices increase, then we still have work to do, and obviously we still have work to do.
Yeah. Okay. Work to do, George. Should we expect any change from the Fed speaker's language real quick?
I think that was me,
I
sorry.
don't think so. I think at this moment, just look at the federal funds futures. Yeah, I think at the end of the day, look at November, December, there's less than a 50% probability of another increase. So I think they're going to wait for a bit. Just like the market is in transition, I think the Fed is in transition, albeit again here, they're transitioning into a sort of a steady state, wait and see kind of approach. And I think with that said, the market also will be relatively volatile.
All right. Thanks. Nice combo, GT. Scott Durfee. Appreciate it, gentlemen. That's it for Morning Trade Live. Thank you for tuning in. We'll see how the market handles some pretty impressive economic
AMC
data.
made a new low there.
When I see you at the closing bell at 2 p.m.
1068.
360
That's
with
a
the
new low.
ladies from New York.
Not good. Just broke the low from the reverse split. Dude. How is this company valued? How is Laser valued so high? Up on 11 o'clock. 30 minutes to EU close. Got 14 likes on this Wednesday. Thank you guys for your support. I made opening bell. Thanks for your 14 likes. Hanging out at the lows still. We're the new low on the day. Down 0.8. Tesla's down 4% today. Lyft is also down 4. There's solar down 3.8. Upward down 3.5. Nice, Bubba. Well done, man.
the government's stance on the future of Apple
And
products,
back.
as well as just foreign brands in China. However, limited measures by central governments don't always necessarily have a massive impact. Last year, it's important to note, Congress did pass this measure that banned TikTok on government devices, and that hasn't dented the popularity
Tick up there on barbecue
how much Americans are
above
using
the
TikTok here in
barcode.
the U.S.
We're down 1.5
I thought that
now.
was a really good point. This is obviously not exactly the headline you want to see, as we're just about a week away from that iPhone 15 release. However, analysts at CFRA are still very optimistic, saying they are still projecting the iPhone revenue cycle to grow 5% in the iPhone 15 cycle, largely on some of these easier comparisons from a year ago, as well as now just this rebound from the COVID supply chain constraints and lower overall U.S. units sold during the iPhone 14 cycle. So CFRA is still very positive. Apple's still one of the most resilient and one of the most profitable companies throughout our coverage. So I'm sure that iPhone event will still be a very powerful one, Nicole.
All right, Jenny Horn, markets correspondent. Thank you so much. Good to see you, Jenny. All right, let's get some insights in the news shaping the markets. For that, we welcome Peter Tuchman's with us, senior equity floor broker at Trade Moss. Thank you for being with us.
My pleasure.
I mean,
Peter.
I'll start with oil. When we see oil at $87, $88, Brent is $90, you know, that means inflation could be rearing its head once again. I know everybody expects the Fed to do nothing in September, but what does this mean?
You know what? Look, I think the Fed has made it clear to us that they could do anything they want to do at this point. Look, if they're not happy with the way things are going, they're ready to pivot. I've gotten that sense of every speech is given, even the Jackson Hole, that it is, you know, and they say it over and over again. Sometimes you take them more seriously than others, but it's clear to me that they're looking for the next shoe to fall. Look, we did not really anticipate that oil would take this massive surge we've seen, but clearly that seems to be what sort of is the flavor of the moment. That's the focus right now, because we're sort of in a bit of a lull, right? August was the first down month we've seen in 8, right? And up till that point, the market's been quite strong. So what is it that's going to move the market on the upside or downside? Technically, the market seems a little bit overbought right now, and I think that contributes to the little bit of a pullback in August. But, you know, the net, if we were really worried about a major move by the Fed, the market would be making net, where the market is right now, a move of a couple hundred points up or down in the market is not that significant that we should be concerned. I think it's more interesting to know what's happening with China, what's happening with the Saudis and oil production, because that story usually is a foresight into what's going to happen in the future. Once they start cutting production and it starts affecting the price that we're paying and it starts affecting the way the Fed positions themselves, then the story that's going to be now, I think, the story for the next few weeks.
In the meantime, as we have the oil story, another one is the ARM IPO coming out. It's coming up. And this is the biggest tech IPO. I think it brings a lot of optimism for folks. It's not just SoftBank and ARM, but it really brings a theme, doesn't it, for investors who are interested in IPOs. I mean, they have to be careful when they're going to invest their hard-earned dollars in any IPO. What do you think about this one? What does it tell folks?
Look, I am IPOs is one of the things that I specialize in. Here on the floor of the New York Stock Exchange, we do IPOs better than anyone else. Unfortunately, we did not get this one. It's being listed on NASDAQ, and that's it's disappointing to us here on the floor of the NYSE. But it's, look, the way the environment is around IPOs, and we've seen this over the years, when the environment's been good in the market for IPOs, there's a lot of enthusiasm, there's a lot of fuel, there's a lot of backwind coming into the whole market and to the IPOs. We have not seen, look, the IPO market has really been up against so many challenges and headwinds. I think it really goes back to the WeWork debacle, right? Look, for a while there in 2018 and 19, the environment was really spectacular. Then we had COVID, then we had the influx of the SPAC phenomenon and whatever happened there, but we've really not had a good environment for IPOs. Sure. The market's just been skittish in that way. And so there's a lot of chatter around this IPO that is this going to be, look, tech sector IPOs are important. IPOs of this size are worth paying attention to. Sure. And I think that the market is looking for something to blast open that door, that maybe it's time, because there are a lot of companies looking to list, right, that are sort of in the, waiting for their plane to take off. And so if we get a good IPO on the ARM IPO.
Fine,
I
low
think
today
it
they're
will
just
open people's
melting down still.
eyes about it, and I think it'll be a positive thing for the market.
You have Apple and Google and some of the other names interested, in investing in this. This is a monument. This is a blockbuster, $52 billion. I mean, this is no joke. So this is we had some exciting ones like Kava, Mediterranean, but no $52 billion.
No,
I mean, it's like,
billion and no tech. Right.
Right. So anyway, it's a big deal, and I'm glad that we brought it up. And then in the meantime, between now and the end of the year, do you have certain sectors or investment advice? I know we've had slower growth in China, but certain things are looking pretty good too. What are your thoughts for investors between now and the end of the year? Should they put money to
Here you go,
work?
barbecue.
Oh, absolutely. I think
Santa Claus rally?
Plus
you know what?
1.8% on
my gut
the
is that if we identify the challenges that we've got right
24,
now, they are not putting any pressure on the market. Think about it. We're almost at 35,000 on the Dow.
Breaking up
we're
out of
at
that barcode.
4,500 on the. Where are we on the S&P 500? We're at 4,500. 45, right?
44,
so look, even in the eyes of 14 months of continuous interest rate raises and the challenges that we're seeing globally, and whatnot, the market is still at a really reasonable, valuation-wise. I know people think it's a little bit long in the tooth, but net relative to where we've been for the last year, we've had a spectacular 2023. Let's look back to 2022. Stocks were absolutely decimated, especially in the tech sector. So my gut is, if they really did not have confidence that the market was going to have a good end to the year, people would be selling here, and they're not.
And they're
people
really
way
not.
smarter than me. So my gut is, I think there's a lot of people still on the sidelines waiting for that reason to buy into the market. But you know what? Net, the market feels strong to me. And I think coming into the end of the year, it should be positive.
Yeah, so feeling, more positive and more optimistic
I'm feeling
than
more
not.
positive than not. Exactly.
Yeah, understood. And the moves, today, not the NASDAQ, but less than 1%. That's nothing. That's just regular trading.
You know what? We have not seen over the last number of years, we've not seen less than 1% move on a daily, let alone there's plenty of things that the market could be selling off about, and it's not. Right. So to me, that's in absence of a real reason to sell off the market, I think people are dipping their toe in and starting to buy some stock.
All right, Peter Tuchman of Trade Moss, thank you so much for being with us. All right, coming up next, the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes to the technicals. Theo Trades. Don Kaufman takes us to the trades for Toll Brothers, Target, and the energy sector. Next here on Trading 360. We'll be right back.
Well, talking macro. All out. Yeah, it does, like, talking about that, like when it starts. It's so weird. Or there's a gap between the news and the music. I don't know what went on with Wii this morning. Halted up, now it's back red. There it is. WeWork begins to renegotiate leases globally. I doesn't know how to respond to that. Yippee! Aw. AMC's got a little RSI divergence on the 5-minute, but yeah, actually it's setting up one here on the hourly too, since it did make a new low. See if he gets a little bounce, confirms it.
You see this sort of level for some
Darkman.
time. Ben, take a look at the charts. Right?
Oh, he
We've
drank
been
ink
hovering in
again.
this really since, I guess, end of July, right?
Yeah, 80 is a key level, Nicole. It's a pivot area. It's the middle of a range that we've been in. It's equally as significant as the upper and the lower extreme. And right now we're in a really well-defined trend environment to the upside on the more intermediate time frame. A little bit of weakness as of recent. You can see that in the chart behind me. And you can also see two areas of consolidation that are separated, very well-defined separation here. And this is vertical separation. You got the horizontal consolidation around 84. You get a breakdown here. This is just a look at the most recent
I added some of the calls there.
activity. Or the price activity we've seen this week, I should say. After that breakdown, again, horizontal consolidation around 80. So I just really wanted to focus on this more granular time frame just so we can see the two phases of development and you can see the characteristics associated with them, the difference between, right, night and day. Horizontal, vertical, into horizontal, and we'll continue to transition. The bears are looking for this to continue to the downside, but I want to show you what's been going on here in terms of that longer term trend, because here you can see it has been to the upside. Now, in terms of what Don's talking about, he's talking about a potential breakout below this lower level, the lower extreme of this range that we've been in. Nicole, you mentioned since the middle of June, we've been very much sideways, and here it is, in fact, right around this $80 level. For me, it seems like that trend continues to be intact until we take out 74. I think Don was talking a 72-ish area. That coincides with the beginning of June lows that we saw. So right in that area, yeah, if we were to start to get below that, it would signal a bit of a breakdown and potentially further energy to the downside. Coming off the failed breakout here, which coincides with that upper extreme high we saw back in July, not necessarily what the bulls wanted to see.
Got a lot of upside we
right?
can still get today.
Scenario, they were looking for a vertical move to the upside and then a new area of balance.
Going to stream GME no matter what. That's true it is today. Yeah, we'll stream it.
But still not necessarily bearish at this point. Again,
I'll probably make a separate stream for it though, in this one and start a new one for it.
I want to show you where we are on the 50-day or relative to the 50, the 200-day moving average, because it kind of speaks to the trend up here still. being intact. Testing the 50, coming off that key area right now. RSI was somewhat limited in terms of participation to
GME
the
into single
upside.
digits.
You can see that as price was breaking out, relative strength indicator wasn't necessarily participating.
All right.
Possibly the first signs of something bearish here. Don might be onto something, but again, we got to take out some key levels that were established on the way up before I start to support that downside narrative.
All right. Thank you for all of that. And, you know,
Liechtenstein.
I also think about seasonality sometimes when it comes to the world of homes and home builders.
Why are we going to go green again?
Don, on this one.
Yeah, no, I like to be right on the bleeding edge of a move. And in this one, the stall alone is enough for me
your
to
pen
actually
was bleeding a little bit, Shark.
Let's actually move forward in a bearish trade and take
there
just
you go.
a nice
Barbecue's green,
defined risk
24.50.
shot for a $2.20
1.8%.
that can make as much as, you know, $10 and a $10 wide spread. I think it's worth the shot. So you don't have to be right all that often when your risk reward is staged in this fashion.
All right, next up, oil is
24.60 up 2.3.
We're watching XLE, which has been trending a little bit higher of late over this month of August. What are you thinking here?
Well, first and foremost, oil has been rather astounding to me. Not just the resilience because of OPEC, just the resilience in the supply-demand, you know, impact in here. However, my trade is actually going to be a bearish one specific to the XLE. Now, yes, we can talk about, you know, slowing economic growth in some of the developing
You close in
countries
10 minutes.
and so forth. We can talk about slowing growth
flip.
inside of China. But this one is technical as well as fundamental. And the technical in here is the XLE. This does appear on a 3-year time frame to be hitting kind of a triple top in and around that 93 level. As such, I'm going to bear up. And again, I think this one is very, very early. But again, better to be early than not in this thing at all. November 17th expiration. I'm going to give myself plenty of time to be right, plenty of time to be wrong.
That'd be late than wrong.
Buying an 89 put, selling an 84 put. So it's going to, again, be a nice defined risk, compact spread. This one's done for a $1.25 debit. Again, that 93 area, fairly critical, though, for the resolve of this trade in just the next couple of days.
All right, bear up. Yeah, I don't really hear that phrase too often. Ben, your thoughts?
Well, you're definitely not hearing that phrase very often in terms of talking about price activity in terms of crude as of right now. I think Don's probably out on a limb on this one, considering the run-up we've seen as of recent, considering the trajectory to the upside, some of the momentum in, well, not only crude oil futures, but also in shares of XLE. Taking a look at the move up, you can see in this instance, it's a very well-defined bottom left corner to top right. We recently came off this high up around 92, and you can see this comes after, well, lows that we saw down around 87 last week, and a nice $5 move to the upside. I went ahead and identified some of the areas of consolidation where values formed along
inverse
the
head and
way
shoulders
up, so
forming
we
on the
could
low
just
here.
determine here, again, these stopping points, these horizontal, this horizontal phase that the market transitions into, and how as we see these moving higher, we can establish trend to the upside. Again, pretty well defined here. Talking from area consolidation last week around 88 to the current one we're forming right now around 91.50, as long as we hold up above 90.50. And again, we're talking about a 5-minute candle chart here, so we don't want to get too married to this more granular time frame. Let's step away from this. Let's actually look at a bigger picture chart, longer term, hour, more intermediate, and a very similar pattern playing out here though, right? You've got a bottom left corner to top right, again from 92. We've rallied up to, I should say, from the lows we saw back in the beginning of June, end of May around 76. So very well defined bottom left to top right in this instance, and a similar pattern again in terms of what we just did with the 5-minute. On the hourly candles, we can establish areas of consolidation. Here you can see in this instance, as long as we're holding up above 88, it looks like on the 60-minute time frame, we're still in a trend environment to the upside. That working assumption that value continues to form at higher and higher levels continues to be the case. Now, as we step away from the 60-minute time frame, I just want to show you on the bigger picture what's going on, because Don talked about these 3 tops here, again up around this 93
We're
level.
breaking this channel.
To me, like actually 4 tops up here, Don. You can see there's been some resistance at this level. So if the bears are going to flex their muscle again, this would be a key area where you expect them to step up, Nicole. But you can also see in this instance a pretty well-defined trend environment to the upside. Again,
rising DRS numbers.
Not only on the hourly, but we're
Let's see,
looking
did
at
we get them last
candles
earnings?
Here. This goes all the way back to, we're talking the spring of 2020. So a pretty well-defined trend to the upside here. Yeah, coming in.
Yeah, good point, Jack. Could just consolidate for a bit.
About in terms of this being
you closed
a key
in 6 minutes. And we're in the middle of the day now, so
you know, and that's the whole thing when you see some of these
ugly
trends
price action
tops.
for a bit.
Don, final thoughts there.
Hoping for more continuation stuff
all,
today as we had a continuation of the downside.
Bear up. I mean, I'm going to use it a lot from now to the end of the year. But again. So specifically though, that 93 level, it is pivotal for me, because if it actually hits the 93 level, pulls back off of it, I think we actually have a nice shot. Look, I like to be the first one through that wall on a lot of these trades. And again, that is often contrarian to market bias.
Okay, next up, it was the most loved retailer, then it wasn't. Went from a high to a low pretty recently. Target. It's around 124 today, right? What are you thinking?
Now, if Ben did not like some of the previous trades, he's really not going to like this one. As I said, I like to be the first one through the wall, right? So here is actually going to be a bullish shot. I think in terms of the consumer is getting beaten up out there, and the consumer is finally starting to roll over. But a huge portion of that is already effectively priced into many of these retail stocks. Retail stocks are getting just annihilated, possibly for good reason. But I think at this point that it is far
down 23
overdone in terms of the sell side, especially scandal stocks like a Target. In this particular case,
slowly climbing
I'm
up.
going to be taking a bullish position, but I'm going to give myself a bit of time. Okay, have we found a bottom in here? Not necessarily so, but again, I think that a huge amount of that downside has already been priced in, that the retailers have been beaten and bludgeoned. So here, the November 17th expiration, I'm going to be buying a 135 call, again, buying a 135 call, selling a 145 call, so it's $10 widespread. It's done for a $1.90 debit. It's a nice, cheap, incremental shot, if you will, for a big burst back to the upside, that ultimately the consumer, they can be dead, but we just think that retail at this price is overdone to the downside.
All right, let's see if Ben doesn't like this one. Maybe he'll like it. Maybe he'll say Target has a chance here. Let's see, Ben.
Don, the eternal contrarian, living up to his name, his reputation, and in this instance, I don't see it. Again, Nicole, we're trending lower right now. If we were to get up above 132, I would maybe shift that sentiment or that mindset, that working assumption. But taking a look at this chart here, again, a more granular time frame, so I don't want to get too focused on the hourly time frame for talking bigger picture, longer term here, but you can see a nice move lower since the middle of May. We're talking 162 all the way down
I don't think we can join S&P because last quarter we weren't profitable, right?
3 areas of consolidation. Most recently, 132 prior to the breakdown that we saw into the end of last month, and then you can see a little bit of sideways overlapping rotational price activity. Now, earlier in our discussions, we talked about the 2 phases of development, right? And you can see that pretty well defined here again. Back in, again, the middle of May, end of May, we were bouncing around 158. And then look at this area here where you get that very well-defined vertical separation, and then you transition back into that horizontal pattern. But I want to show you something else, because it's not always so easily identifiable in terms of that separation, the vertical separation. Sometimes it's kind of overlapping more so than really well-defined vertical. In this instance, gives us a pretty good example of both. Look at this. 175 and 158, 2 areas of consolidation that formed in the beginning of the year. We just talked about the 158. You can see the separation here, but in this instance, the breakdown from 175 to 158 was not as well defined as what we saw in the middle of May. And a similar pattern playing out here again, 132 and 124, more overlapping, rotational. One could even argue this is one larger area of balance if you wanted to step that far back. Speaking of stepping one more pace back and a look at a bigger picture time frame, I've got, well, hold on one second here, because we're talking Target, and here it is. holding below the 50-day moving average, holding below the 200-day moving average. RSI somewhat limited in terms of participation to the downside, but really no indication that the bullish narrative here is supported in terms of price activity as of yet. Now, again, if we were to start to see a bottom forming here and start to see some movement to the upside, I could buy into that one. But still, as of right now, from what I'm seeing here, Nicole, looks like potential for further downside momentum.
Okay, thank you both so much. A great big three today. Really appreciate you both. Don Kaufman of Theo Trade and our own Ben Lichtenstein on the charts today. For Toll Brothers, looking at the energy ETF and Target as well. Thank you both for the big three. Coming up next, we're spotlighting the automakers. Negotiations are ongoing with the UAW. That union appears to be headed for a strike. Names like Ford, General Motors.
AMC just still selling off. 24% now. Ugly. $4.50. Things at $1.03 pre-split. $4 to $1 in like what, 5 days. BBBYQ up 2 1/4, 24.59. There's EU close. Kind of coming down a little bit on it. All there. I'm sore. 3.5 on barbecue. Doing it. 24.88. High of the day. Retesting that right inverse shoulder. It holds.
500, but there has been a lot going on underneath the surface. The street is actually expecting revenue to come in at $1.14 billion and the adjusted earnings per share coming in at a loss of 14 cents. Now, that would be an increase of about 60% on a year-over-year basis. What does that mean? That means incrementally better than what we saw last year, which is what you want to be able to see, but they still have a cash flow problem that they are going to be able to address here. The software growth right now, the estimate is looking at trying to increase around 26.4% on a year-over-year basis, but collectibles is looking to contract around 17.2% on a year-over-year basis. In the last earnings announcement, we did see that CEO Matthew Furlong did step down, and we also saw Ryan Cohen actually elected as the executive chairman of the company here, and they did not have a conference call, which had a lot of investors really scratching their head. Let's see if they're going to have a conference call on this earnings announcement here once we get it after the close. But one thing to note, Nicole, usually when we get the announcement when it comes to the financials, we don't really see a move in the stock until the next day. I'm not sure why that's the case. That tends to be the case when it comes to this name. The market is implying around 11.6% move to the upside or downside. That's what's being priced in the options market. So we are going to be looking forward to this earnings announcement, and hopefully we do get some additional context as to their strategy moving forward as well to try to become cash flow positive as well as gap positive when it comes to the adjusted earnings per share, which it does have a little bit of a ways to go until that can happen.
Okay, we'll watch for all of that. A good preview of two names that everyone's interested in for tomorrow. For today. Thank you so much. All right, Kevin Green, senior markets correspondent. Now let's turn
that
our
right
attention
shoulder.
and spotlight something that's going on, the ongoing labor
up and down.
dispute. U.S.
Still green, but
the big three. It's a big
see.
subject. Ivan Feinsess with us, senior partner, chief investment officer, director of research at Tigris Financial Partners. Thank you so much for being with us. So recently, it wasn't long ago, we got the okay, that the news on the okay that they were in fact moving forward, had the paperwork to move forward to actually put together a real strike. This is a huge clash. What are your thoughts?
Well, it certainly comes at a difficult time for the U.S. automakers, the big three legacy automakers that are trying to ramp up production of their EVs. And the situation is that they're investing heavily in EV production, that initially the margins won't be there, so the cash flow won't be there. And at the same time, the UAW strike is coming up for negotiation, and they're looking for significant pay increases and hour reductions, along with concerns about whether the EV production will require less labor or not.
You used to really like some of these names. You used to say buy for some of these automakers. What do you say now?
Well, I still do. And I think any weakness over, if we should get a strike or over some major labor issues, any weakness in Ford or GM, and even at these levels, I think is a buying opportunity, because we are undergoing a major revolution in the auto industry, and more is going to happen in the global auto industry in the next 3 years than in the entire 120-year history of the auto industry combined as we make this transition.
So names like GM, Ford, I think of Stellantis here, which it's not too far off its $20 high. It's at $18. You like all three of these, but you would buy on weakness. Is that how you would do it?
I covered GM and Ford. I have a strong buy on GM and a buy on Ford. I also like Rivian very much. I think Rivian is ramping up. They have a path to profitability. They have a great product lineup between the two trucks they have, and they have a third truck coming. I think they're really doing things well. They're well received by the consumer. And I really like the company here.
Yeah, I like that you brought Rivian into the conversation, because as we talk about EVs, that's really the trend, right? I mean, that's what everybody's really talking about here, and that's why this whole strike may occur. I mean, how do you feel about EVs versus, the combustible engines that we once knew?
Well, the biggest issue still is charging and range. And it was great that GM, Ford, and Rivian all are joining the Tesla network, which gives access to the Tesla chargers. As well as GM has several initiatives. And if you look at coming online, they'll have about 60,000 chargers across the U.S. coming online over the next year. So it is about charging. And over time, the batteries will last longer. The battery is the biggest component cost to make an EV. The costs will come down. The batteries will last longer. They will charge faster, and there will be more places to charge as we go through this ramp up and this conversion of ICE vehicles, internal combustion engine vehicles, to EVs.
But you do think, and your prediction is that there will be some last-minute negotiations.
We've had it on the 5-minute, yeah. Had on the 5-minute. Ever since that first drop.
There may be some potential stoppage and some maybe work
on the
without a
3-minute
contract because the auto industry cannot afford a stoppage. And therefore, the union may have some leverage here. And we have seen a lot of strikes.
More bullish
going
now,
on.
especially
not
with
only the SAG-AFTRA and the writer's strike, but there's been and the recent issues with the Teamsters and UPS. But there's been a lot of different regional strikes. Labor has really been flexing their muscle here, and it's a difficult period that this comes at this time for GM and Ford.
Yeah, well, I hope you're right, because I think you're right. I think the whole transportation industry, some way, shape, or form, has had some labor issues, to your point. Thank you so much, Ivan. I'm glad you were with us today. It's big news and obviously one important sector to follow. Ivan Feinseth of Tigris Financial Partners. All right, coming up next, Zscaler. After its quarterly report, see it down about 2.2%. George Silas will take a look at this stock and give us an example trade. Thank you. Coming up.
Okay, I'm adding my last call there. One last call. Still very early and very much into the middle of the day where we see a lot of chop. So there's always that risk. Grabbed on the breakout, it keeps projecting. This had an engulfing candle yesterday. That is neat. Not support. Doubly neat. Spy. Boy.
Gives you an idea there's more visibility
Break it.
in the prospects for Zscaler, which again, from a cybersecurity standpoint, is still not profitable on a GAAP basis. They are profitable on an adjusted basis, but they still haven't proven themselves as a profitable company on a GAAP basis. Now, with that said, If you look at some of the analysts, they're rather constructive on the stock. Deutsche Bank increased their price target to about 185 from 165, and they maintain a buy rating. But at the same time, you got Barclays increased their target to 176, but they maintain an equal weight rating.
It is low energy, you're right.
Why Barclays is doing that, considering the stock is trading around 73 times forward earnings.
Under special Flesherinos out.
So with that,
those are my favorite for lunch.
How do you go about an example trade here?
Well, so in this case, Nicole, we're just going to, always is the case, we're going to take what the market is giving us. If you actually look at Zscaler, effectively it's been in a trading range for the last 2 years between, of course, let's say 190 to 110. So it's been an $80 trading range, and it's sort of in the middle of that range. So we can capitalize on this because
don't be too hasty because we have a lot of upside we could do.
It was actually very good, but the stock isn't reacting very positively, and I think it's got some valuation issues, and maybe that's why the market is not pushing it higher. So with that said, we can continue to participate by effectively trading in this trading range, and we'll actually sell an iron condor or credit combo going out to October monthlies and selling the 175, 185 call spread that's above the current price, and then of course below the current price, we'll sell a 145, 135 put spread. Altogether, you can sell it for about $3.50 a share or $350 a contract. So it's a $10 wide spread. Your return is $350. Risk is, of course, the difference between the spread and the credit of $650. You're getting basically more than 50% return on risk. And what we're doing in this case is we'd like to see the stock, ideally speaking, in the next 44 days, stay below the short strikes, 175 to the upside and 145 on the downside, which is about $15, give or take, up or down.
Understood. George Sillas, our disruptors every single day in today's Zscaler. Thank you very much, George Sillas. Coming up next, have you looked at American Eagle Outfitters? Looking at that chart, which has been running up. In fact, in 3 months, it's up about 46%. So we'll dive into the retail space and find out if back-to-school sales boosted clothing stores. And what else do we need to know about American Eagle Outfitters?
Got 15 minutes for me to close. Might have been the bottom reversal on SPY. We'll see though. Barbecue wanting to get back green. Uptrend. GME bouncing there from the lows. Down 1.6 now. By middle of the day chop. Presumably. Alright, getting back to that right inverse shoulder. No more chop.
It's really a tale of two stores, and I think the biggest thing to look out for is how the American Eagle banner is doing in comparison to Aerie. Aerie right now is just a total rock star as far as that group. In Q1, they were up double digits as far as top line. They're by far the most penetrated online. 45% of their sales are coming online. And then if you just look at things like their social media traffic and TikTok searches, I mean, they're so much more relevant and then packs so much of a bigger punch with consumers, with the target audience than the American Eagle brand does right now. So my biggest thing to look out for is, hey, will Aerie continue growing? Will it continue being that growth engine for the group? And if that is the case, what's happening with American Eagle? Is it going to continue being stagnant or even declining? And if that big time trend continues into the future, what are they going to do, right? What do you do when you have one rock star and one kind of more stable, stagnant brand in your portfolio?
Yeah, understood. And Corey, as we're seeing back to school sales now, and then it'll be holiday sales, where do you see the strength? Are there certain names that you have buys or strong buys that you think can buck the trend regardless of the pressure?
Sure. So I think within specialty, we actually ran a survey of around 600 consumers in the U.S. to gauge back to school sentiment. And it actually indicated that 26% of respondents are intending to spend more at American Eagle Outfitters and Aerie into the season. So that is one thing that is relatively encouraging. Other brands that screen quite well are Abercrombie and Fitch. And I think I went on the show about 8 months ago and said that was one of our top picks in specialty space. And now it's up over 100% since. So that one's done really well as well and continues to do very well.
Yeah, thank you for that. You're right. When I take a look here, it's up 136% year to date. Emerson, what do you think? I mean, you have some of the other smaller fast fashion, right? Like Zara, for example. Forever 21 was another name you were looking at. What names do you think can fare well this year?
Yeah, so news broke, I think, just last week that Forever 21 and Shein, the behemoth online fast fashion retailer, are going to go into a partnership. And I think the idea is to cross-list their merchandise and cross-market and go after more share of wallet with the target customers. So that's a huge one to keep an eye on. We just published a blog on McMillanDoolittle.com on what we think could come out of that partnership, but definitely a big X factor. And then we keep hearing guidance from Zara and Inditex that they really want to invest in the U.S. market and bring that Zara and those Inditex brands up to par, in one of their weaker geographies. So I would keep looking at those two, and I think really the landscape's going to get a lot more competitive and a lot more challenging for brands like American Eagle and Abercrombie and everyone else in the U.S. if these two things take off.
Yeah, and then quickly, Corey, how are people shopping? Are they using their phones more, going in the stores more as we get ready for the holiday season?
So we've definitely seen a pretty significant return to stores. So online businesses have been a little bit pressured because of that. And this is all, I think, a COVID rebound dynamic that we've seen. Interestingly enough, we are seeing credit metrics spike. So typically there's a percentage of tender that is done via cash and done via credit. We're now seeing a greater proportion of some of the retailers I talk to of transactions being done via credit. So I think this is indicative of the consumer becoming a little bit more stretched. And then as we look to potentially in October, the restart of the student loans, that could be an additional headwind. So I think this is something that is really important to watch as we head into the back half of this year. And it's going to dictate, by and large, how many consumers are going to choose to allocate their dollars as we head into holiday.
Okay, thank you for all of that. Corey Tarlow, Emerson Delgado, thank you both very much. That's going to do it for me here on Trading 360. I'm Nicole Petalides. I will see you later at 2 p.m. Eastern Time for the Watch List live from the New York Stock Exchange. Keep it right here. Fast Market is next.
Bubba got his preemptive 12 o'clock flush there. You selling that red candle, Bubba? That red to green? A negative delta here holding. Yeah, you gotta wait for the midday chop to decide which way it wants to go. Have a full house here. Oh.
At 11 o'clock Chicago time, 12 o'clock Eastern. The S&P 500 down 13/16%, 37 points to 44.59. The NASDAQ 100 down 1% on the nose, 155 points to 15,000. 351.
Your
The
noon
Dow
flush,
Jones
Bubba.
Industrial Average down 0.5%. Yeah, we're using fractions. 216 points to 34,424, and the Russell 2000 down just over 0.5%. 9 points, just under 10 points to 1870 and some change. Now, I'd like to bring in my co-host. You've seen him before. He's on just about every show. Let's bring in Mr. Alex Coffey to the show. And Alex, welcome, as always, a frequent flyer on Fast Market.
You make a higher low here on SPY.
This is an interesting kind of week. You know, I thought it was interesting. Liz Ann Saunders put out some data this morning about September being historically one of the more bearish months of the year. Hedge funds have upped their short positions. You're seeing some some upticks in short hedges. We've got a market that's down now for the second day in a row on, taking some news that's not game changing, but relatively, soft, in terms of the airlines, things like that. What are you seeing start the day here? Why are we down? Is it just, hey, everyone trading this market, pay attention to the calendar?
I think there's a lot of things kind of going on. First off, the market's run a long way, Kev.
Yes.
And it's sort of, we use that old kind of term and cliche, the market's climbed the wall of worry. And it really has been this kind of, needle that has been threading some very, very tight spots throughout much of the year. There's been this thought of, we want to get inflation under control so that the Fed, stops putting the pedal to the metal, let's say, on tightening monetary policy. But at the same time, we also don't want to see significant economic deterioration, have some sort of deflationary recession, 2008 2.0 scenario. But we need to see some sort of deflation in the economy to think that we're going to see prices come off of, sort of their ascent higher. And so a lot of things have to go right to get this so-called soft landing. However, we keep seeing kind of signs that cloud the picture. So today, the most recent one was the ISM Services Index was a little bit hotter than expected, and it's okay number. I think it was in the 54 handle. It's nothing there is really scaring the children, if you will, that, economic recession, at least on the services side,
GME earnings will be at
is there. You combine that with the fact that
aftermarket,
on the manufacturing side, we saw
between
signs
4
of
and 4:30.
hope for a bottom,
earnings call.
sort of a rounding, sort of bottoming.
You're gonna have one,
a little
which
bit better than expected
I think they
on
probably
that
will.
front. Well, yeah, still
But maybe not,
contraction,
since it's
but
Ryan
not
Cohen. Maybe
as
he just
deep
won't
a
do them.
contraction as it had
That
been.
should be
This makes it a little bit complicated for those who think that the Federal
usually
Reserve may pivot
within
down the line. And
an hour from close.
look,
you
I'm
have
not one to go to the camp that whatever
their
the
filings
Fed's doing
as
is
well
going
as
to send the
earnings call.
direction of the market, because based off that logic, the market should be a lot lower as the rates have gone higher. Yet since where they began, I think hiking rates, I think we're actually at least basically in that realm, like basically where we were. Because you recall, we started off a little bit weak last year, but we didn't actually hike rates until March. And so you look at all that combined, Kev, I think the market is optimistic but cautious at the same time. And so you see down 38 in the S&Ps, and while in 2015, 2016, when I was really getting into markets, that was a huge day. But the S&Ps were 2,000. That's not even 1% now. It seems like a bigger down move than it actually is in reality. And then I look at volatility, and it's saying there's nothing that they're worried about. And so I see that as this is just the classic ebbs and flows of the market. Some corporate news in names like Apple and Microsoft are weighing on the overall market sentiment. But this is nothing that I would necessarily sound alarms about.
Yeah, when I was on with Ben Lichtenstein on the Future Show this morning, on with Oliver
Checks
Rennick
all
this
in.
morning,
I love it.
the dollar was lower,
yeah,
yields were lower, and crude oil was lower. They're all higher now. They've all moved higher on the day, thus putting more pressure on stocks. But one stock that's doing extremely well today on some cost cutting or some head count lowering, and that is Roku. For more on this, let's bring in Miss Caroline Woods live from the New York Stock Exchange to cover this stock, Roku. Pretty good reaction, Caroline, to some cost cutting on Roku's part.
Hey there, Kev. Yes, shares of Roku up more than 6% right now, off earlier highs, but still seeing impressive gains. This after the company boosted its revenue outlook and, yes, announced some cost cuts, which include laying off 10% of its workforce to bring down year-over-year operating expense growth rates. In addition, Roku said it will consolidate its office space, perform a strategic review of its content portfolio, reduce outside services expenses, and limit new hires. So those layoffs that I mentioned, 10% of the workforce, that will result in a restructuring charge of about $55 to $65 million. Office consolidation will mean $160 to $200 million loss, and then the streaming cutback could mean $55 to $65 million loss for this.
Sure thing, Sam. Yeah, we'll be streaming it.
In terms of the updated revenue,
I'm gonna end this stream, market close, and start another one for the GME earnings specifically.
$835 to $875 million. The prior review was for $815 million. That doesn't include the restructuring and impairment charges. Q3 revenue consensus on Wall Street is for $829.2, so also better than what Wall Street was expecting. Meanwhile, Roku says it expects to lose between $20 million and $40 million this quarter. That's narrower than the $50 million loss previously projected by the company. So we're seeing shares up about 6.2% right now, up 118% year to date. But if you zoom out on that chart and look at the pandemic highs where Roku was trading, in the 470 region, long ways from there, but it's really seen an impressive run higher so far in 2023.
No doubt about that. It's seen as a positive story today for the stock in particular. But Caroline, I wonder, from the chance that you have to speak to so many different analysts and market participants there in New York, is this becoming a worrisome trend? This isn't the first company to downsize workforce, focus on costs, and consolidate real estate. And so while if it was just Roku, this would be an interesting headline, certainly. But we're starting to see this basically be the trend. And at some point, we've seen job openings come down pretty dramatically. We're starting to see job growth fall off dramatically. Are we starting to see signs of this labor market cracking that the Fed has been looking for?
You know, Alex, more and more I'm hearing that soft landing scenario on the table. Even people who previously were forecasting a recession, obviously we've been talking about it for so long, really since that yield curve inverted, are starting to change their tune in terms of just how strong the labor market or resilient the labor market actually is, and how strong and resilient the economy has actually been. So yes, the expectation is for a cool down and a moderation, but I wouldn't say that these headlines are making people more pessimistic about this economy actually falling into a recession. If anything, I would say word on the street here is that people are definitely more optimistic. Still some recession calls. I will say when it comes to Roku specifically, obviously cost cuts in general, these headlines are good news for the stock. But in terms of the analyst community, I'd say analysts still largely cautious on this name, despite the fact that it is so far from those pre-pandemic or during the pandemic highs. If you take a look, only 35% of analysts have a buy rating on shares, and the median price target is $85 a share. It's currently trading at 88 today, so trading above where the majority of analysts or the median analyst price target is. I did see a note from MoffettNathanson, who has a sell rating. The analyst there has a sell rating and a $55 price target, which of course implies double-digit downside from here, saying though many believe Roku's efforts will help improve the company's bottom line, Roku will need to invest more to remain competitive in the crowded marketplace. So actually have to spend more versus just focus on reducing costs. So a little bit different of a view than just specific to the head count there, but not all optimism on the street despite what the stock is doing today.
A little late on the calendar, but another year of efficiency that we're going through in the markets. Caroline Woods, thanks for coming on, as always, spending some time with us. All right, now let's bring in our first guest, and that is Mr. Nick Theodorakis. He is the Managing Director of Risk Management at TD Ameritrade. Nick, welcome to the show. You know, interesting market we have here, Nick. Not major earth-shattering, top-tier economic data news, but the calendar matters. September's kind of a bearish month. You're seeing some news affect the market, but this market just seems a little bit heavy. Is it so simple, Nick, that it's valuation that's taking the market a bit lower?
Well, yeah, I guess. I mean, that's always the deal, right? You know, when things are expensive, they get sold off. So I think broadly speaking, that's probably true, Kev. But I feel like, not tons of data this morning, but the data we did get was strong, and I think it does tie a little bit to this sort of good news is bad news scenario for the markets as well. You couple that with some of the reports on the big tech names, and Apple in particular down 3%. It's awfully tough when the top 3, 4, 5 participants in the market by market cap are dragging things lower. That's why you're seeing a little bit more of a sell-off. But the ISM number this morning was strong again. Mortgage rates fell, so you can kind of look at probably increases in housing demand from that. When you get these sort of growth forecasts, positive numbers that come out, I think the market's taking that negatively right now. And we heard the first of many Fed speakers this week, telling us that rates have to be restricted for longer. There may be more increases out there. So I think there's this really thin tightrope that we're walking.
Might get a double bottom here on the market.
Caroline, we're hearing more and more people say that we're seeing the soft landing as a possibility. I always worry when that becomes the norm, right? When that becomes the mainstream idea, because if the Fed does have to continue raising because everybody thinks it's going to be a soft landing, they could just go back to spending, and racking up, 20% credit card debt, and then there's a bit of a fall off from that. And I think there's a consequence there. So we just have to be careful. And the Fed is certainly not going to be lowering rates anytime soon. And if they go back to raising, it's because this data is relatively positive. That's not great for stocks for sure. So not surprising. Then you see the strength in the dollar, right? That the sell-off. Also kind of agree with what Alex said here. Just, valuations have gone a long way. As the markets are so big now, a 0.5% pullback isn't that big of a deal, just normal course of business. But good news, a little bit of a bad interpretation here continues to be the story, in my opinion.
Alex, of the 11 sectors of the S&P 500, utilities are unchanged. The rest are pretty heavy, right, today. And as you look, the Magnificent Seven, those 7 stocks like Nick talked about, so important to this market, they're giving you no help. Actually, they're hurting you on the downside here. Your thoughts is, this is pretty broad sell-off. Doesn't feel like a crash. Doesn't feel like a real spiking VIX, even though the VIX is now 14.5. What do we make of this market? Is this the beginning of something? This is day 2 of softness here. What do we make of it?
Well, I think it's actually a little bit more than just day 2. I think the last 2-3 weeks and really much of the month of August were a little bit weaker. I think there was a tone shift in August from what we had maybe the 3-4 months leading up to it. And so while I said something like today is not maybe the day that you're sounding the alarms, I mean just simply about today. I think there's plenty of reasons to be concerned about the trajectory of the market. I think they are really not unknowns, though. I think these are the same stories that we've talked about for the better part of the last 6 months, if not the entire year. Primarily being, well, we had 3 straight quarters of earnings decline, yet you have the market going higher. And so at some point, that is valuations becoming, larger. And so then you have to wonder, okay, what merits an increase in valuation? Because it hasn't been interest rates going lower.
Shouldn't be interest rates, right?
But it hasn't been growth either, because we haven't actually had growth. We have 3 straight quarters of no growth when it comes to the S&P 500. And so I start looking at this and say, we've had a very concentrated rally, to your guys' point, primarily driven by names like NVIDIA and then the ancillary businesses associated with the artificial intelligence. And the question has to be, is that sustainable? And if not, where does that money go if it comes out of those names? If there is a bubble, and it is popped, even if it's a small pop of that bubble, and you get back a little bit of that rally that you've seen in names like NVIDIA, which is down 3.6% today, where does that money go? Does it go into things like treasuries? Does it just go into cash waiting for opportunity? We've read a lot about, big name investors like Warren Buffett raising cash, or, famously Michael Burry, putting out big short positions. Look, that's interesting stuff, but the same way that, September has been a volatile month. It's all just interesting data. To me, the question is, why would they be doing that? And I think the answers are very clear. It's because the market action doesn't necessarily jive with what actual reality has been, but the question has to be, what is the expectation? Because the expectation has been for a recession for a long, long time, and it hasn't come, at least in definition, recession. Certainly in earnings it has.
Well, the good news is we're going to cover one of those stocks in our next segment, which is Apple. Let's take our first break of the show, come back with Nick Theodorakis and Alex Coffey, and we'll go through Apple. Remember, it's in 3 of the major indices. It can really affect the market, and it is. Take a quick break. Come back with more Fast Market on the Schwab Network. See you then.
I might be double bottoming there. See, still chopped around midday. I've got what, 3 hours left, 4 hours left. So plenty of time. I hurt the Kings.
Put that move today in perspective. Apple's currently down just over 3%, 3.25%. It's up 45% on the year, and that's sort of the laggard in percentage terms. When you think about some of these other big tech names that we've been talking about, NVIDIA is up 200%. The Nasdaq itself is up 27%, right? When you look at the move today, so we're really talking about
we're gonna get an earnings call,
30% rally. So I guess I'm just putting it in context, guys, of what you were talking about before. Like, do you just put your money in treasuries? Well, it's really nice that you can get a 4 or 5 7% yield depending on where you're at on the curve. But if you're really in it for growth, those yields just don't compare with what we've seen, sort of year to date or year over year in terms of stock market. So I think it's really important at these levels to balance where you're getting in. And if we do get a bit of a volatile September and we see somewhat of a pullback here, maybe a good entry point later in the year for some of that dry powder that you're holding on to. But again, be cautious here about jumping in with stocks up so much on the year and interest rates so high. But again, I think Apple itself specifically, headline driven today. There's some other stories that are starting to come out as well for Apple around what the iPhone 15 and 15 Pro release will look like, what the watches are going to look like. Always tons of rumors out there.
For prison.
But we're pretty certain that there's going to be a switchover in terms of the charging port for Apple because of EU regulations. So they're going to go to a USB-C.
AMC still selling off.
And you can look at that two ways. There's a headline out today saying that may be a negative. It may hold people up that don't want to
probably
change
diluting
over all
right
their
now.
cords. If you're a nerdy first adopter like I am, then you're excited to go to one charging cable, but that may not be for everybody. And there's concern from some analysts that may actually slow down the upgrade cycle. So you pair those two together, and I think it makes a little bit of sense why you're seeing some pressure on a name that's come so far this year.
Alex, let's role play. If I'm Tim Cook and I'm getting that phone call, I say, wait, I make the iPhones in your country and you're banning them? Great news. Thank you. I'm just kidding, of course, but
they're trying to not make them there, though. Keep in mind,
exactly.
So there's
they
a little
are
pressure.
Transitioning. Yes,
Look,
you're right.
We've made decisions as a country, and our companies have made decisions as companies, and then they expect not to have retaliation. Like at some point, this is just. I mean, it's common sense that we're going to have, tit for tat and some of this stuff. But I actually think the EU ruling in which Apple is specifically called out as a potential gatekeeper in basically how it operates business has a lot more meaningful long-term impact.
I saw that they were
if it actually has the spillover effect.
planning to dilute. I guess you don't know when they're going to do it.
Saying,
I don't know if it's at the market or what.
Doesn't allow for competition.
Right.
You have your own apps that you don't let customers take off. You don't let app stores come in. Oh, and then you charge huge fees within your app stores for any apps that are on.
But yeah, today's price action itself does look like they're
and so,
offering shares up.
The EU's Digital Market Act, basically known as DMA, ruled down 6 of these names. You know them all. They're all big-time players. But Apple's the one that this is basically written down in pen and in red ink and saying, this is exactly the kind of thing that the EU doesn't want to see. Well, if they're forced to make those changes in the EU, what's to say that other jurisdictions can't say, hey, you just made those changes over there. We'd actually like you to make those changes here as well. So now all of a sudden, potentially offload of assets, potential complete rewiring of how they actually operate. You're talking about a lot of potential lost revenue and a lot of money spent to actually get this thing in compliance.
Barbecue,
and if they don't
dance
do
around
it,
BWAP.
fines up to 10% of global turnover, which can be up to 20% if they keep repeating in terms of offenses. So look, I don't know where this is going to go.
I don't think AMC is pulling GME down right now.
Yeah, the EU is a very
I don't think they get tethered unless you have volatility.
When it comes to regulation, Nick, your final thoughts on this, and then you have a trade for us.
Yeah, they do, and they do influence. California has similar, kind of stances on things, right? They tend to be the leader in terms of setting policy. So, yeah, they could. And when you look at Apple, they're clearly a target, and they're the 7th largest market cap, right? When you think about countries, right? We say this every time, but I always like to put it in perspective. And you've got the 6 largest economies of the world, and then Apple. So, of course, they're a target. Of course, people are going to want to sort of extract their pound of flesh, so to speak, from them and make an example of them. But Apple does that in the name of privacy. So I think they do have, the stance that they have because there's so much customer data on their devices, leading from a security standpoint as they try to do publicly. I think makes it a little bit harder for others to follow suit. But things like, standardized charging, standardized, fees, things that are impacting the entire EU population are tough to fight. They're big macro issues. I still find it awfully difficult to think that in the kind of in the short term, as we think about option trading here, that this is a major derailer. And I really agree with your point, Kev. I read that headline. I thought the same thing. Like, yes, they're trying to diversify supply chains a bit, but Tim Cook has to be working to smooth that over and say, look, we're manufacturing almost all of our devices still on a percentage basis in your country. And we have to be able to work this out. So I don't know if that happens today or tomorrow, but I think that headline to me doesn't materially change their sales. There is a pretty decent percentage, almost 20% of sales come from China. You're not hearing about broader crackdowns there. If you were to, I think that's a concern. But so far this appears to be a governmental thing, and I wouldn't be surprised to see it get smoothed over, given that manufacturing relationship that you're talking about. It may just be posturing to try to keep more manufacturing in the country, right? I think there's a lot of angles that you can take here. So. Real simple on the trade in terms of mentality on this one, Kev. Just it's a bit of a buy the dip strategy. We don't often talk about long verticals. A lot of times we're selling premium, but just don't see a ton of elevated volatility given the news that's out there. So I went out to the October 6 weeklies and I was buying the 190-205 call spread. I sent it over to you guys at $2. The stock's gone a little bit lower since then, so you could buy it for about 185 right now. And when you're buying a vertical, obviously the risk there is the premium that you're paying. So if you're paying, say just $2 for our example here, your maximum risk is $200. The difference is the profit, is the potential to make what is the difference between the strikes less the premium that you've paid. So on a $15 widespread, if you're paying $2, you have a $13 profit potential on the trade, but you need a move, right? But the thought here again is that it's traded up, above 190 pretty substantially for the last few weeks and down on this headline. So going out past the announcement of the new iPhone 15, let that kind of shake out. A lot of times we do see a move lower after the announcements. People tend to be underwhelmed, but then historically they've pretty quickly gone back to buying the stock. So this is a little bit of a longer term play, bullish. Call spreads, we're paying the premium here, limiting our risk by the premium that we've paid, with the potential to have max profit if it goes up above that 205 strike.
Alex, a $15 vertical spread 30 days out gives you about 26 deltas, and this is a risk-defined strategy. It's trading about 185 now. It's up there at $2. Like Nick said, the stock has moved a little lower. The risk is the debit on the trade. It could go to $15, but Alex, as you know, you need movement. You need your long option is out of the money. You need movement to the upside here, but you got 30 days to get it.
Yeah, a couple things I think that stick out to me, and you should see right away if you're kind of looking at these option trades. Anytime you see risk a lot less than maximum reward, think probably lower probability of success, exactly. A little bit more speculation involved, and. The next thing you notice is, oh, wait, the break even is $9 higher than where we're currently at. Makes sense. I need something to happen. Therefore, I'm taking a little risk relative to the possible reward. But I think it makes sense, gives it enough time, but it also captures that event. So if you're bullish on a stock that's gotten beaten up post earnings, post some kind of macro issues that have become micro issues for Apple, and maybe excited about what they may have to say about their next iPhone release, given the last couple have been a little bit lackluster. Maybe you do see something where this stock pops as a result, and that's all this one asks for. Just asks for upward movement. This break even, these risk rewards, all this is theoretical. That teal line is all theoretical expiration. In the interim, it looks a lot more like that purple line, and any type of upwards movement likely going to be positive for this particular trade strategy.
What Alex just said there is so important when you're looking at the risk reward of a trade. If the payoff is exponential to the debit paid, chances are the probability is lower. There's a 71% chance that the 190 call out 30 days goes out of the money. But if you're buying the tip, if you get the move, if you're correct in that assumption, you get an exponential winner on the upside. I want to thank Nick Theodorakis for coming on.
Low there.
He is the Financial Risk Management Director
Those
at
in our
TD
chop
Ameritrade.
hours.
We're going to take our second break of the show. Coming up next, we'll get Megan Brantley finally is back on the show from LikeFolio.com.
Oh, there's your
She's going
flush.
to talk about GameStop. Oh, do we have to? Yes, of course we do. Take a quick break. Come back with more Fast Market. See you then, everybody.
Here's your flushy flush. Bubbalicious got his lunch hour flush. Get it to that next support. Run. Hearts got there. Just trying to slow play him a little bit. I don't like those hearts. I figured you might go all in. Let's see. You got it. You. I've done that before though. River. That freaking dude. Well, SPY making another divergence. Me flushing on it too, down 4%. AMC is below $1 pre-split. 50 cents.
Trade-ins, they sell used hardware and things like that in games, and so there's a perceived value there. And there's also a new membership program that gives perks, whether it be savings or cashback and exclusive bundles and deals and things of that nature. So that's GameStop's value prop to the consumer, and that's what consumers who do talk about shopping with GameStop talk about as what brings them in the door. The problem is that now we're seeing, increased competition. Games are being published digitally directly, so consumers don't necessarily have to go through a middleman like a GameStop. And we also see increased mentions of people talking about shopping at places like Amazon or places like Target just for the sheer convenience factor. And so whenever we look at our data, we're listening to how those mentions have changed over time. And you can see here on this chart, these are consumer mentions of, interacting with GameStop. And those are trending down, and they have been now for a couple of years, pretty in tandem with the stock. So mention buzz is down by about 57% year over year. So that's a little bit of a warning sign for us that GameStop has lost some of the hype that it gained when it was this meme stock darling back a few years ago. And we're not necessarily seeing signs of a turnaround yet when it comes to that overall buzz.
Megan, first off, congratulations and welcome back. But, I think that this is kind of interesting. It's kind of the story that everyone knows, right? Which is they were thrown a lifeboat due to the meme stocks. Crazy amount of equity was created in terms of market cap. They could do things to raise capital to try to get to the other side. But what's the other side? I mean, they had some rumblings of like NFTs and things, I think, at one point. But that doesn't seem to be investor interest at this point. So I guess, is there anything here that's positive? Is there anything to be excited about? Because from a fundamental standpoint, I mean, I don't think anybody disputes that it doesn't necessarily merit the valuation it carries. It's just kind of an interesting stock that had a lot of trading volume and excitement. But if that excitement's gone, what's left?
Yeah, I think that one positive you could say is that the bar is pretty low. Heading into this earning, I think that people are just looking for, a narrower loss versus profit. So, the bar is pretty low for GameStop heading into this event. And we've also got a leadership change. They let go of their CEO last quarter. And so there could be some optimism maybe surrounding potential new strategies. I know that investors will be listening for, how does GameStop plan to turn this around and really garner the attention of the consumer again. But at least from our data perspective, we just aren't seeing any signs of a real strength from GameStop. Even when we look at those digital mentions, that's an area that GameStop has been trying to lean into. Those web visits have fallen by about 20% year over year. So we're not necessarily seeing the changes to that business strategy take hold yet. We're not seeing the mention buzz take hold. And then whenever we look at consumer happiness, if you zoom out on a big picture of things, that tends to be our most predictive long-term indicator for a company. And that happiness level has dropped by about 4% year over year. It's around 65% positive, which isn't horrible, but it's not great. So I think that for us, there is still a lot of room for improvement before we would have room to believe there's, a big surprise in store for this name.
Yeah, Megan, this company's supposed to lose 14 cents on about 1.1 billion in revenue. They fired their CEO. They don't really have an earnings call when they release their earnings. The Likefolio data kind of looks like the chart of the stock, which looks like this stock is saying a long goodbye. It does trade volume though, and it does actually move. What else? Is there anything else we should do here, Megan?
No, another area that we can look at from our
6%, Jesus, a lot of theta decay.
I think you mentioned,
unless you got a bad entry.
NFTs and even some collectibles, and that was giving GameStop
Seems
some
like
hype in previous quarters, and we're not seeing that sustained interest there. That's kind of lost its luster. So even whenever you look at these macro trends, we're not seeing a ton of tailwinds for GameStop. I will note this is kind of a down quarter. A lot of times whenever we look at GameStop, we see mentions uptick around big game releases and around the holiday season, and we haven't seen a lot of those big releases, and we haven't, obviously it's not the holiday season now. So this quarter, if we were to pick a direction, our data definitely supports more of a move or a bet to the downside. But I will say, because the bar is so low, that any positive news in regard to leadership or, narrower than expected losses may be well received. So definitely important to stay risk defined on this one.
Megan, one last thing, just for the viewers at home, make sure we're all on the same page. Your data typically, from what I remember, is seeking to kind of track how revenue might perform. In a name like GameStop, you can have the earnings results in front of you and have no idea where it's going to go. Does that complicate it a little bit?
It does complicate it, and that's a really good point, because I think that that's contributed to a lot of its volatility in the past. And when we look at these consumer mentions and we look at all these different metrics, we are correlating that to revenue. So whenever we talk about these metrics, we're not seeing signs of a great increase in revenue. I don't necessarily know that extreme growth is expected.
I know it's your third
but we
pick,
are
brother.
seeing consistent declines pretty much across the board in all of the different metrics that we're tracking.
Megan Brantley, Vice President of Research at Likefolio.com. Thank you so much for coming on the show, and welcome back. It's great to see you. Congratulations. Next time you come on, we want a cameo from the new member of the family. Have a great day, Megan.
Perfect. Thanks, guys. You too.
All right. Unless you have your finger on the pulse of this name, Alex, unless you really have an idea for what you want to do, I would say don't trade this name. But if you really want to trade it, if there's something you can do, my first thing would say stay risk defined, because this stock could move up or down. Keep your trades small, keep your debits or your exposure to a minimum. The trade that I looked at for this is something that plays for movement in either direction. It's tight. It's not a lot of exposure to this market. It's not a big debit. It doesn't need like a precise. It's not in the calendar spread family. It's the long iron condor. And as you can see there, I'm buying the 2022 call vertical. Just in this week, I'm buying this 1816 put vertical. I'm spending just a couple pennies over $1 here. It's drifted up slightly, but it's almost a 50-50 shot. And the risk is $1. You can make $1 on this trade. It plays for movement in either direction. Alex, tell me why either you make a trade like this or none at all, or what would you think?
So we looked at GameStop yesterday on NextGen, and I think the only thing that I would take into consideration that would maybe work against this type of strategy is not the thought process. It's more of whenever you have a name that has this much short interest, I'm a little gun shy about short calls just because of the assignment risk being basically on steroids, and it can complicate things. And if you're not as, I guess, in tune with options and comfortable with sort of those risks, it can complicate the process of getting out of the trade and possibly bring other factors into it because it's such a hard to borrow stock and because it's a, basically there's a lot of interest to try to get those short shares. So that would be the one thing that I would consider. But if you want to express volatility in this name, no better way, I don't think, in a risk-defined manner than what you're describing here. We looked at essentially half of this trade yesterday.
The most important lesson you can take from this segment of this show is to control your risk, define it. A great trader once told me, if you are naked long or short options, you are borrowing the money you're making, and they're going to come back for it eventually. Do I know that for sure? Of course not. But learn how to control your risk so you can play tomorrow and make trades that you want to make, not that you have to make. All right, this is a long iron condor.
Barbecue down 3%. Now it's below VWAP.
$1, a little over. With you can make $1, you can lose $1.
AMC,
you're playing for movement.
They're doing their share offering today.
All right, let's take our
28%.
final break of the show. Come back with a market update from Ben Lichtenstein, George
Lichtenstein.
We'll look at a stock that we have never covered on this show, brand new, coming up in the next segment. I want to thank Alex Coffey for stopping by. Take a quick break. Come back with more Fast Market on the Schwab Network. See you then, everybody.
Give me 4 puts on the Qs. So today they're on SPY, AMC down almost 30%. Flushing down some more, it's down 1.06%. Well, 45. Cash for likes, we're at 17. Ups. Hey. We have GME earnings after hours. It's just been melting down literally all day. No retracing, no. Start off with our puts at this double top. Just held them all day, I guess.
Tough day for Fed Chair Jerome Powell and the inflation hawks as well, right, Kevin? This isn't what they wanted to see. Prices at the pump here are expected to rise if we see this move up in crude continue. If higher today, 6 days in a row to the upside, Kevin. 8 out of the last 9. And as I take a look here, something like 9 out of the last weeks, 9 out of the last 11 weeks have been to the upside here as well. Again, to $88 right now, breaking out and back to levels we haven't seen since November of last year, the fall of last year. Next big hurdle for the crude bulls is on the left side of your screen there. You can see it up around 93, 95. Now, this is actually interesting because, again, it coincides with strength we're seeing in the U.S. dollar. As I mentioned, rates on the rise, concerns about China, right? Even Europe had some disappointing data overnight. The factory orders raised that discussion about stagflation again. So keep an eye on crude here. Again, further advances at this point continue to pose headwinds for stocks and the bulls and inflation hawks.
Great job as always, Ben. Thank you so much for coming on. That is Ben Lichtenstein, the host of the Future Show with Ben Lichtenstein every morning at 8 a.m. Eastern on the Schwab Network. Make sure to check him out. Now, let's cover our final stock of the show, and that is a stock. This is the first time we're ever talking about it. It's an AI stock. It's called C3AI, and for that, I want to bring in live from Salt Lake City, Utah, Mr. George Tills to the show. George, C3AI, frankly, had to look this one up to figure out what it was. This stock has had quite a run this year, George, up about 300%, if my math is right. What are you finding on C3AI?
Yeah, it's made a nice run. It's actually pulled back since June, Kevin. But C3AI, I mean, it's a namesake artificial intelligence company. It actually provides platform as a service-based technologies for machine learning, artificial intelligence, both in the private and public clouds. They have affiliations with companies like Google, and they actually serve multiple industries, particularly the industrial space, oil and gas space, where Baker Hughes is actually a very large customer, representing more than 20% of their sales. But I think the stock has performed well this year because we know there's been sort of a secular trend going on with artificial intelligence. But I think you have to look at what the company is going to be reporting this afternoon to determine whether or not this is a meaningful investment. Because if you consider earnings per share, they're expecting to lose 17 cents a share, and that's actually down about 41% compared to the 12 cents of a loss last year. So just keep in mind that the losses are expected to become a little bit worse this quarter than last, with sales expected to increase by 16% to $772 million from $65 million last year in terms of sales for the quarter. So I think this will be an interesting one. Ideally speaking, there's a high short interest in this particular name, and the reason being is if you look at the last year where the company generated about $260 or so million in sales, they're losing quite a bit of money. They lost about $282 million in net income, and effectively without a profitability picture, at least going out to 2026 for C3AI, I think in this market environment there may be some pressure on this name.
Yeah, George, we've heard, you and I have gone through this story many times. It's not making money yet. However, revenue is increasing. Revenue going to be up, to $72 million. That's a nice revenue level of growth. But George, is that enough? Right? Is this growth accelerating enough to make this a bet? Stock's not really that cheap anymore in terms of valuation. The dollar value is reasonable, but the valuation's pretty high, George.
Yeah, well, there's a few things. I mean, looking at it from a pros and cons standpoint, I mean, it's trading around 13 times sales. That's a con. If you look at the forward estimates, I don't have a positive multiple to really go off of for C3AI. I think that's going to be a concern. At the same time, if you look at the market capitalization, it's around 3.7 billion. They do about 730 million in cash in equivalent. So if you consider the cash burn, which again, on an annualized basis, if we go off last year, is about 280 million, they have a cash cushion. But at the same time, they don't have free cash flow, and they have a negative 55 million free cash flow print in the last 4 quarters. And so ideally speaking, free cash flow moving in the right direction, getting closer to break even, if not positive, usually speaks to earnings which actually move positive as well. In other words, free cash flow typically moves first. So I think that's going to be a concern for this name. I can see why the short interest is very high at 33%. But at the same time, look, sales are still in the double digits. If they do denote some increasing sales, perhaps an additional partnership with a major artificial intelligence or technology company, in which they do have partnerships with Google, as well as one other thing to point out, that Baker Hughes, which is a large customer, if they actually demonstrate some broadening out of the number of customers versus the concentration of customer risk that the company has, I think that might bode well for the company. So expect a lot of volatility nonetheless in this particular name, but there's a preponderance of shorts on this as well. So you could see a short squeeze. That's something else to keep in mind.
Great job as always, George. Thank you so much for coming on, covering this stock for the first time ever on Fast Market. Have a great day, George. All right, the trade we're looking at in a name like this, take this as a lesson, not necessarily a recommendation in any way. The learning point of this segment is the strategy, and that is in the diagonal family, but it's a different kind of diagonal. Many times, Tom White and I talk about diagonals on the show as buying a higher delta call and selling that front expiration call there, making it a long delta diagonal. This one is going to be different. We're doing a double diagonal, but it's a short spread on either side, where that embedded short vertical is within. What do I mean by that? I'll show you. Look at the makeup. Look at the risk profile of this. You are going out to September 15th, so only 9 days until now, but you are in the September 8th, in the September 8th month, remember, that's this week, you are selling the 34 call, you are selling the 28 put. Then going out to September 15th, something we do many times in the calendar spread family, in the diagonal family, you are buying the 36 call and the 26 put. So what did you do here? You are short the 34-36 call diagonal, that's the right side of your screen, and you're short the 26, you're short the 28-26 put diagonal. So short 2 verticals embedded in this calendar spread. And what does that do? That creates a credit for this. And so what you're looking for is a range-bound strategy where you are, remember, a diagonal is in the calendar spread family, but there's an embedded vertical. In this case, it is a short vertical spread. So that allows you to do something in the calendar spread family, but for a credit. So you can see where it peaks out, still peaks out at the short strikes. In this case, it's the 34 strike on the upside. It's the 28 strike on the downside, but there is risk on catastrophic moves, obviously, because you're short the $2 vertical. You see the range down there, you lose about $155. That's the $2 minus the credit. On the upside, you do about $130, the $2 minus the credit. So you see the difference here. There's some time, but you could come out of this week long the 34 call, long the 28 put, or I'm sorry, the 36 call and the 26 put. So this is the strategy. The most important part of this segment is the strategy. And the strategy here is the diagonal with the short embedded verticals. It's collecting theta, it's long vega, right? But this is a range-bound strategy for something like this. Okay, so this is an interesting, it collects about $50 a day in theta. It's very flat, less than a delta on either side. But like I said, you're looking for a range-bound move in this trade. All right. That's our show for today, everyone. Thank you so much for coming in and spending the last hour with us. For all of us here at the Schwab Network, have a great day and great afternoon. Alex Coffey and Jenny Horn coming up next with Next Gen Investing. Have a great day, everybody.
Still melting down, 444. Contracts I bought this morning went over 1,000%. Oh, that's great. Happy Monday. Do you still have them? No. Continuation day, we're calling it. Trade. Barbecue, little move down there. It's down 4% now. Consolidating in this range. AMC down almost 30. I have to do another reverse split by the time they're done with all this dilution. Been a great short trade. Triple. Adam Aaron. Curve short. Oh, they're on SPY. More fleshy flesh. Yeah, I would have doubled my account today. That is neat. More than doubled it. I down 1.2% here. My longer term puts like this, I guess. Always that. Big red candle.
Times its sales. That was back at the end of 2022. Now we're seeing with this massive surge that the stock has experienced in 2023, it's trading at just such a rich valuation relative to 2022 levels. So we have seen the significant pullback. Still, valuation is pretty high into this earnings event. However, this hot rally this year has been driven by at least a fundamental change. We have seen a surge in interest in a lot of their AI tools. So I guess you could argue that naturally the valuation should have increased, but still, we'll be watching these earnings first quarter expected today after the closing bell, and what has been a banner year for C3AI, Alex.
No doubt about that. Very much still in the growth stage, but not growing that much. So this is hype driven right now. And as long as this hype train keeps rolling, maybe there's more upside for AI, not just C3 AI, but AI as a whole. However, I almost look at this C3 AI chart as like the barometer for AI hype. Names like NVIDIA have shown dollars and cents as to how it's helping them. They've been able to maintain some of their gains. But C3 AI is basically ebbing and flowing with kind of how much AI is in the news. So we'll see if they can change that narrative when they report earnings. Looking forward to that one. Next one on the list is DocuSign. This is a name that was the kind of cornerstone of this particular technology, which of course allowed for contracts to be signed securely, not actually having to put pen to paper. It crushed it during the pandemic. But then the question that always comes back to these names that get kind of way ahead of themselves in growth and borrow all that demand from the future is, we only do really one thing. So how are you going to capitalize on this? And DocuSign kind of failed to live up to those really high expectations. Nothing against the company, just got a little ahead of itself.
Okay, and I was reading about their earnings. They are expected to release their second quarter tomorrow after the closing bell. But this is also a fairly regulated industry, like legal documents, some ID verification. So it's also difficult for them to grow as quickly as they'd like, just given the fact that they're usually serving a more legal or, you know, like a more, I'd say, documented process. I thought that was a really interesting point.
A little bit more risk in what they're doing.
Exactly. So that's to me why some of their growth has been, I mean, more tepid, to put it lightly. They're down about 4.5% this year. Although they do still have a pretty impressive earnings surprise history, having surpassed Zach's estimates in all of the last 4 trailing quarters, the average surprise standing at around 26%. We are expecting top line now to signal about 9% growth year over year, and the street is expecting some growth likely steered by their robust adoption of all things web forums across several industries, significant advancements in innovating their tightly regulated markets, as well as some recently expanded ID verification premier features. So they are still expected to grow, at least on a year-over-year basis. Earnings is expected to come in 50% above last year's figure, but I'd say right now we're facing some relatively easy comps. Last year they got hammered just to not be able to grow to the expectations that were set forth during the pandemic, and now we're sort of in a more normal world, more I'd say regular world. So they're now seeing, I'd say, relatively easy comps after they just getting crushed last year.
They do a lot of things really well. The problem is I'm just not sure what the barriers to entry for another bigger company to come in. We've already seen names like Adobe and Microsoft explore this, and so it's becoming an increasingly crowded space, Jenny, and when you don't have other core businesses, you have the most to lose. We see that with Zoom Video, Microsoft Teams. Even if you like Zoom Video more, if you're, XYZ, Fortune, whatever, 100 company, S&P 500 company, and you've got a 30-year relationship with Microsoft and they offer you Teams for free, why are you going to be buying Zoom Video? And so that's the issue a company like DocuSign is going to run into, which is if these bigger players start doing this effectively and they can just bundle it with other things they're already doing, you kind of just get cut out of the market.
Right, and I mean, I don't know about you, but when I recently signed a lease, I didn't even use DocuSign. There's so many other competitors out there that are even small, very similar, but it's not like DocuSign dominates all things the market. So that's also a concern, but we'll obviously wait and see once we get those results. Our next name today, though, we're steering back to the retail conversation. All things American Eagle Outfitters. Now, the question remains, will they be like an Abercrombie & Fitch post-earnings, or will they be like a Foot Locker? Obviously, we'll have to wait and see when they report, expected also today after the closing bell. They are expecting, or we did actually see from this company, they were able to post some healthy revenue growth, up about 2.5% year over year last quarter. They did also beat analyst estimates. Guidance, though, for this quarter's revenue and operating profit was generally speaking pretty fine. However, the company's full year outlook was below expectations last quarter for both revenue and operating profit. So overall, we saw them report a pretty mixed bag. So this quarter, analysts are expecting revenue to rise just over about 0.1% on a year-over-year basis, slowing down from the growth they recorded in the same period last year. Adjusted earnings are expected to come in around 16 cents per share. Major analysts that have covered this name have reconfirmed their estimates
transaction down there, down 4.78.
More bearish or more bullish, just have somewhat
22.90
where they were.
We hold this
However,
support
looking
still.
at some of their peers, like I mentioned, Abercrombie & Fitch remains one of the leaders in the retail space. Urban Outfitters was another strong name, and then you have department store names, which I know are very different than American Eagle, but you have names like Nordstrom, Macy's that just took it on the chin after earnings, and then Foot Locker, Dick's Sporting Goods. So we'll have to see if the theme of all things retail shrinkage is one that is going to weigh on a name like American Eagle's when they report.
Is this company still rightly named American Eagle, or should it be shifting its name to Aerie? Is that the growth side of this business? Because I haven't heard of much of a renaissance of American Eagle in the way that we've heard Abercrombie & Fitch, but to be honest, I was never an American Eagle shopper. So when we look at this one, what numbers are we going to be focusing on? Are we looking at just the whole business? Is Aerie really the growth driver, much like companies like Gap sort of had Athleta at times carry it, or recently in Urban Outfitters, Nuuly's been a big growth engine. Is this more Aerie now and then hoping American Eagle just kind of churns its wheels here and stays strong at wherever it's at?
100%. I think that's such a good point, because I think that these companies now, they're pushed into athleisure seems to be their bread and butter. You have Free People now launching Free People Movement, which has been a consistent revenue driver for that brand. I think Aerie right now drives the entire brand because they've done such a good job sort of capitalizing on what has been the pitfall of a name like Victoria's Secret. So I almost think the Victoria's Secret's loss has ended up being their gain, because Aerie has
bit of a green candle there on SPY. Maybe it's bottomed.
They haven't had, say, the same need, I'd say, for a rebrand,
Like it might
Alex. I mean,
be setting up an
you had
engulfing one as
American or
well.
Abercrombie and Fitch that needed to have as its public perception. This name, I think, has been more of a steady performer among at least brand perception.
No doubt when you look at its chart, it's been, at the benefit. The street is looking at this as much more of an Abercrombie story than a Dick's Sporting Goods or a Foot Locker. But the last one on our list is Zoomies. And so the stock ticker, when you look at it, Jenny, is Zooms, and it's kind of fun. And, every time we look at this name, I think to myself, is this that store that I used to go to when I was younger in the mall? Shout out Oakview Mall in West Omaha. That sold like some cool shoes, and then it is. Every time I'm kind of surprised to see that. So glad to see that it's still doing okay when it comes to kind of being around still. You never know with some of these mall stores, but Zoomies, first time I think we've talked about it in at least several months.
I mean, so it's, gosh, and also this is such a mall company to me. When I think of the mall, I think of like Auntie Anne's and like Zoomies.
Backup account.
Maybe.
Exactly. Maybe Build-A-Bear. When I think of my mall, I think of Zoomies. And, to say they're doing okay is maybe relatively speaking. It is down only 16% this year. However, no surprise, we are expecting to see this company report a decline on both its top and bottom line when they release their second quarter print, which is expected today also after the closing bell. We are expecting this name to just continue to shrink in terms of its imprint as well as really just the quarterly earnings that it's producing here. We are expecting quarterly earnings to drop, quarterly sales to drop around 14% on a year-over-year basis. We also have seen the consensus mark remain stable over the last 30 days. I don't think that's necessarily, though, telling the whole story. This name has taken a hit due to the fact that they've seen what they have said is a more challenging operating landscape, including numerous issues like inflationary pressures as well as more discounts also weighing on their top and bottom line growth. On the last earnings call, management did project now their second quarter sales to fall between 187 and 192 million. That was well below what they had previously set out to report. And from a regional perspective, net sales in North America is expected to decline about 17% from a year ago, while their international business is also set to decrease around 13%. So if you have right now North American sales and international sales both falling, sort of like, what do you have to look forward to at this point? This name's down 16% this year, down about 37% off its highs.
Yeah, I guess doing well needs to be redefined to make that work for this one, but it's hanging in there. Let's put it that way.
Doing well, like it still exists.
Exactly.
GME
I guess
bouncing
our
back
bar
up to
is
be up also
kind of
down
low,
3
but
1/4.
I think this company, a win for this one is not to be Foot Locker.
AMC
after this
almost
report
down
would be a massive
30.
win, but obviously would pair very well with
30,
American
man.
Eagle. But I think the story of these four is certainly the AI and DocuSigns of the world, the tech space. Far more next generation than looking back to the early 2000s and going to the mall. So, Jenny, looking forward to talk C3 AI and DocuSign in our next segment.
Yeah, we'll be moving into the cloud space, stepping away from all things retail ahead of both C3 AI and DocuSign's earnings. We'll be looking at the technicals as well as some example trades. Stick around. Next Gen Investing will be right back.
climbing up a little bit there. See if we kind of regain some of these levels. Drops pretty low, 44630, or around there.
Creating a $10 wide window in which this can be profitable between 45 and 55. If it perfectly pins at that 50 mark, this thing could expand to as much as a $500 profit, which is corresponding, of course, to that $5 credit. It does take $500 in risk, and that risk is if it's a massive move. If it's outside, both 40 to the downside or 50 or 60 rather to the upside. And so this is a strategy that is looking for a limited price reaction and leading slightly to the downside. So maybe the unthinkable in a name like DocuSign, which has seemingly every quarter moved massive percentages.
I know that usually it feels like the story is pretty negative, but I guess given this earnings season, it's been very difficult to pinpoint what we'll see the outsized moves to the upside versus the outsized move, of course, to the downside. But also important to keep in mind for both of our example trades today, multiple legs can lead to multiple transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk like unanticipated exercise or assignment. Now,
15% of those calls.
It's time to look at all things Roku, which is seeing a nice move higher today on the fact that it announced a 10% workforce reduction. We'll discuss more about their cost-cutting measures coming up next.
Don't let me make you thirsty your guts. This is a dumpster fire. Like, we're probably gonna get a good bounce on AMC, but not until they're done diluting. Down 31%. Single digits. No, we're below $1 pre-split. Or yeah, 20 calls, $2 pre-split. Yeah, we're at 93 cents pre-split right now. AMC. I mean, look at the market cap, 1.5 billion. And they made a net income last quarter. It's kind of crazy.
At least given the last 18 months of some overall selling in this name, but we will leave it there for our FOMO segment. Now, coming up next, we will discuss all things airlines. We will be looking at American Airlines specifically after BNP did upgrade shares, downgraded Southwest though, so mixed picture for the airlines today, some collective weakness though. We'll discuss that more coming up next.
Not enough to get this stock moving to the upside here. No takeoff. We had a grounding yesterday in United Airlines, ground stop. Didn't last for very long, but a little bit of a grounding action in the stock price here for American Airlines.
And if you were one of the lucky few that was, or not lucky few, lucky several that traveled over the course of Labor Day weekend, you know that the airports were absolutely packed. Longest security line I've ever waited in my life in Reno Airport, but thankfully made it back. Not everyone in my party did make it back. So it seems like for airlines, you'd think it was successful over the weekend, but this does also mark the unofficial end to that summer peak travel season, that being the end of Labor Day. So now these stocks are in a rather precarious position, lower today on some rising fuel cost concerns. Here to tell us more about this analyst activity, I'd like to welcome in Renita Young, senior markets correspondent here for the network. So Renita, walk us through this upgrade from BNP. I'm not even going to attempt to pronounce the rest like Alex just did, but regarding all things American Airlines, it's a little bit more positive than Southwest.
It is positive, and so even though American rate at BNP Paribas, it is lower today along with the general sentiment testament of what's happening in airlines. Now, first, let's talk about this upgrade, because the analysts took this stock to and outperformed from a neutral and boosted the price target to $20 a share. That's around a 39% move to the upside. This analyst feels like it is positive, or the outlook is more positive on American Airlines, feeling that it is a more stable airline than its peers. For example, you noted that it gave Southwest a downgrade. But out of the analysts who rate this stock, who cover this stock, and they were rated by Benzinga, one is somewhat bullish, 12 or 2, I should say, are somewhat bearish, but 9 are indifferent. And I think that's pretty interesting that we have this one analyst pretty definitively positive, and then 9 who are covering it, who are rated by Benzinga, who are not definitive about this stock. But when we look at airlines on a whole today, the Jets ETF is heading for its 5th straight day of a losing streak. It's still up around 9% year to date, but it's underperforming the market, and it's down around 17% from that yearly intraday high that it hit in July, which many consider the peak travel season, the peak summer travel season, right? But several of the airlines are warning today that they will have higher fuel costs coming in the third quarter. They're cutting their outlooks for some of their quarterly earnings for the next quarter, and it's really got people concerned about what the travel outlook will look like for the end of the year. To give you a couple of examples, Southwest said that fuel costs per gallon are expected to be at $2.80 a gallon for the high end. We also had United, who hiked its gallon or its gas costs to about $3.05 at the high end. And then Alaska Airlines raised its fuel costs to $3.25 at the high end for a gallon of gas. So those higher fuel costs are really causing these companies to rethink their strategies and to revise their outlooks.
You know, Renita, I started looking at a name like American, for example. It's quietly a good 25% off its recent highs. It's had a rough last few months, kind of quietly in the background. And so you start thinking about these names, and we talked about it yesterday with the sort of breaking story that ended up not being as big of a story that it initially sounded. But these stocks didn't really recover. They still had a pretty rough day yesterday, and American wasn't even involved. So to me, this seems to be a secular kind of rotation out of these names more so than anything. And the optimism for sort of this future travel is waning. And so it seems to be exactly almost the opposite of what this analyst is saying.
I think it's more of a case for exactly what you say, especially as people start to spend less money going into the second half of the year, Alex.
Especially with, Renita, these resumption of student loans. I can also imagine weighing on discretionary spend. So it doesn't necessarily seem like we're seeing a lot of growth drivers coming up. But I do know that
what's going on with Overstock
this past weekend, it doesn't necessarily seem like anyone is right now
concerned
news. About their cash flow. It seems like everyone was traveling, and the security line again was so long. So I guess good to see for airlines. We're not seeing that reflected today, though, in their overall share price. But we will leave it there. Appreciate the breakdown, as always, Renita Young, senior markets correspondent here for the network. Now, coming up, last but not least, it's time for Under 30. We are looking at Bloom Energy, which has seen
they just released some revenue report.
But all in all, this name is clinging on to its intra-session gain. We'll discuss that
there's a
more
certain
with George
barbecue
Tillis
today.
coming up next.
Overstock's good. Correct. A nice meme. AMC is saved by Swifties. 40 million share offering. Saying Hedgie short laddering the stock. Nice one, GDM. Fly breaking out the upside. Climb back to VWAP. Fortunately, on my backup account, I have to trade tomorrow's contract, so not quite the same returns, but a little safer to trade at least. Was needed for a late day audible recovery trade. After I closed contracts, I went 1,200%. GameStop up above VWAP there. You think there's going to be an earnings call? If there is, it's most likely going to be Ryan Cohen. I guess you could have like CFO do it. Someone else, but that alone might cause a rip. I don't know.
But nonetheless, I think there's a trend going on with the expectations of perhaps going into fiscal year 2024 that the budget from a federal standpoint will include some additional provisions that are going towards tax credits and subsidies for alternative energy that companies like Bloom Energy may benefit from. So I think that's maybe a trend.
You gonna hold those overnight?
The call here by Morgan Stanley, but they've got a pretty high target. They actually reduced the target from $30 to $29, but that's a pretty significant increase compared to the current price around $15. And they actually see some tailwinds still going on from the Inflation Reduction Act of last year, which will carry through to 2030. While at the same time, coming up with the next year's budget, there could be some additional provisions that go towards alternative energies, including, of course, EV manufacturers, solar, wind, but also you have to think about hydrogen fuel cell as another component of the alternative energy equation, particularly, I think, from a commercial standpoint and industrial standpoint. And that's going to reduce cost of electricity, but also cater towards the needs that are in demand. In other words, peak demand for power generation, which I think if you look at battery storage technologies, they're available, but they're very expensive. And of course, it may not have the same sort of longevity from the standpoint of runtime versus something that's a little bit more consistent in power generation on site.
Still not a profitable company, but does seem to be making sequential improvement towards getting to that zero line. But that's not unique to Bloom Energy. I would
GME
say
above
many of these
VWAP,
companies in this
down
alternative
2.5.
energy space are much in the
AMC
concept
down
proving
30.
phase as opposed to the actual
90 cents pretty
profitability
split.
phase. But you mentioned Plug Power, another name I'll throw in there, sort of in
Barbecue
this
down
space
4.
is,
Man, I thought we were gonna have
fuel cell
a rally
energy.
today.
George, when we talk
They're getting green
Bloom
there.
Energy, Plug Power might be one that we're all a little bit more familiar with.
More consolidating.
What's the differences between some of these companies? Is it just simply end market? I know fuel cell in particular, looking for more marine transportation kind of applications. Is it more about where they're trying to get this technology to,
commitment.
less about how they're actually
Yeah, nothing wrong with a
creating
little
energy?
strangle.
Well,
Especially
at
if
the end
you're
of the day,
entering
a lot of
them
these
at
companies
opportune
are
times.
very similar in the sense that they're using, for instance, like fuel cell or Plug Power, hydrogen fuel cell technologies as their core technology.
Edging is
but I think
good.
the applications are a little bit different. Like I said, Plug Power really focuses on the commercial vehicle space. Essentially vehicles that are robotic.
Now you just want to see more than 11%
are used in
move.
warehouses, like I said, in Walmart and Amazon. Bloom actually has like on-site power generation. It's either backup power, but also to help, of course, fill in power needs for peak demand. So it's a little bit different altogether from the standpoint of Plug Power in terms of fuel cell technologies. But I think at the end of the day, all of them are going to be generating some sort of provisions from a tax credit or subsidy standpoint, which can be very, very helpful from the standpoint of reducing expenses, but also financing the company's expansion. And that's really what's key here, because when you're operating at a loss, which this company is, they lost about $290 million last year on about $1.3 billion in sales. I've seen better, but I've also seen worse in terms of losses. But if they can reduce expenses, which is really what Morgan Stanley is looking at, and I think that it's improved from scalability. In other words, selling more units or installed units, that's moving in the right direction. And I'll close here by looking at 2023's earnings estimates are expected to be down in terms of losses at 26 cents a share. But if you actually look at 2024, they're expecting an adjusted profit of 36 cents a share. So that puts the stock only trading at 41 times 2024's earnings, which again, if they get some provisions that improve their profitability profile, but also sales profile, I can see this target being achieved in the next 12 to 24 months. But again, you have to look at the risks involved, because again, it's not necessarily a technology that's more ubiquitous, like of course traditional power generation, but also like of course traditional hydrocarbon-based vehicles. We know electric vehicles have taken off and they're becoming more ubiquitous, but fuel cell technology is still in its infancy.
Yeah, and I think that speaks to the fact, like you said, this is not a company that's profitable yet, despite the fact that it does have some pretty ambitious goals by 2025. This does still seem like a little bit of a wait-and-see story, especially if you've been watching this name since its IPO back in 2018. But we will leave it there. George, really great breakdown on all things Bloom Energy and this clean energy space, a name that is seeing about a 0.5% move to the upside today. But that also does it for Alex and myself for Next Gen Investing for this Wednesday. Coming up next, we have the watch list with Nicole Petalides.
Barbecue coming down there a little bit on 5.4. It bounced on the trend. What a raise. That only had an ace. The straight came out. What the heck? Mike went up more. I only have one contract left. Pico barbecue. Transaction up at 40. Which are down 2.7. Good afternoon, Jay. Didn't want to call that. 1 minute more for you.
Market, what are we talking about here?
Yes, big tech shares under pressure today. If you take a look, Amazon, Meta, Google, Microsoft, Apple, all lower today after the European Commission basically designated them gatekeepers, basically saying that they're restricting access to core platform services like messaging, online search, advertising. So they have 6 months to bring their core platform services into compliance with the Digital Markets Act. These
I just say market
platforms
time,
include
guys.
social networks like TikTok, Instagram,
Looking at the
Facebook,
stock
YouTube,
market,
browsers like
market
Chrome
time.
and Safari, services like Google Maps, Meta Marketplace, some ad delivery systems from Google, Amazon, and Meta, including also operating systems, search engine, video sharing platform like YouTube. Previously, Microsoft and Apple had argued that iMessage and Bing shouldn't be included in those regulatory requirements because they didn't meet
This is
the
a safe
threshold.
space for all time zones.
Both were left off the list today, but there are separate investigations looking into those. Obviously, iMessage is a classic example. You know, the green bubble versus the blue bubble. You only get the blue if you're using an Apple app an Apple iPhone. Smaller businesses have basically complained of being hurt by these companies' business practices, and this is the EU's way of cracking down on those. And speaking of cracking down, there'll be fines of up to 10% of a company's global revenues for breaking some of the most serious competition rules, and even up to 20% if these companies are repeat offenders. I will say that TikTok's parent ByteDance said, "We support the DMA's goal of creating a competitive playing field in Europe, but fundamentally disagree with the solution." Apple said it remains very concerned about privacy and data security risks that the DMA poses for its users. So this could spark a wave of legal battles, and it doesn't necessarily seem like it's going to be over just yet with these designations, because a lot of the companies are fighting back, but you'll see shares all under pressure today. Apple, the biggest loser, down about 3.7%.
Yeah, and coupled with the fact that the Chinese government now saying you can't use your Apple iPhones anywhere in government buildings. So they get the double whammy today. You're absolutely right. How about Comcast and Disney moving up the Hulu discussions now to the end of the month, right?
Yes, we may know the fate of Hulu a little bit sooner than we once thought. Comcast and Disney are set to begin Hulu discussions on September 30th, far earlier than the initial deadline, which was January of 2024. They jointly own the company. Disney, of course, has a majority stake. Comcast has the minority stake, owning 33% of Hulu. And under a 2019 agreement, Comcast can force Disney to buy, or Disney can force Comcast to sell the remaining 33% stake in January at a guaranteed price of $27.5 billion. I will say, though, at a Goldman Sachs tech conference today, Comcast CEO Brian Roberts said Hulu is way more valuable today than it was then. So something tells me there's going to be some back and forth about what the actual price of Hulu should be. Roberts said moving the date up will provide investors of both companies better clarity on what it means for them. As you can see here, taking a look at Comcast shares, they're higher today, up about 1%. Disney under pressure, off about 0.6%. But it seems like we may know the fate sooner than we thought.
All right, looking forward to that. $27.5 billion I saw there was the value, but as you noted, could be running up, particularly after the battle we've seen in New York, where they're telling everybody you can't watch Disney, ESPN, ABC News, you have to go to Hulu.
And that was set 5 years ago, remember? So, a lot. Brian Roberts, at least, is saying it's worth a lot more than that.
Okay, we'll learn more, and really just feels like just a few days, September 30th. Caroline Woods, thank you so much. Okay, a bigger picture here. We bring in Matthew Johnson, president and owner of Johnson Wealth and Income Management. Welcome, Matthew. Look, we've had a pretty resilient market, but at the same time, August has been under some pressure, and now you're getting in some stronger than expected prints, like the ISM services number. Things just in the beginning of August, it seemed light. Now we're starting to feel like things are picking up again. What's the forecast here?
Well, thanks for having me back on again. I don't know if 2023 is going to be termed the it depends market year, but it sure does seem that way, doesn't it? Like everything is so interconnected, and everything seems to be so data dependent, and everything seems to be dependent upon each other. The banking crisis that we've seen earlier in the year was really a result of what the Federal Reserve did. The big question right now is, what is the Fed going to do in the future? What are they going to do? Like you said, just in 25 days, is it going to be something where we're going to see, rates being hiked? When we look at the market, I have to say I'm nothing short of impressed, because the market and the economy has stayed extremely resilient. But at the same time, that good news is really bad news, because we know that the Federal Reserve is really looking for weakness. And we're starting to see some things that are developing on the horizon that I think could lead to, that recessionary cliff that we're all kind of worried about. We're seeing the slowdown in the German economy. We're seeing the slowdown in the Chinese economy. And we know that to some extent, even though they may be quite small, they have an impact on our economy. So when I see these stronger prints, and then yet I can look in a different corner of the economy and I see weakness, it really doesn't surprise me much, because we know that everyone is really looking at what's going to happen over the course of the next 4 months.
What if the Fed hikes again in September? Is that, I know the Fed funds futures are showing that it's not likely, but at the same time, do you think they may?
I really do. I think that the Federal Reserve has felt like they were kind of the whipping boy in the sense that, they were blamed for not acting soon enough, and now they're taking the approach to say, well, we're not going to be really accused of not going far enough. And I think at this point, they need to stop. That's been my sentiment for about the last 2 to 3 months, that they need to just take a bit of a vacation and let things kind of see where they're going to settle out. But I'm not so sure. There's so much of a 50-50 here. We can look at one piece of data that suggests to us, okay, they can go ahead and halt from here. Yes, rates may stay high for a longer period of time before we see cuts. But then you look at other areas of the economy and you're saying, gosh, it looks as though they really do have the justification if they're going to raise hikes or raise the rates another 25 basis points.
Meantime, the Fed's Beige Book says some Fed districts saw consumers exhausting savings and turning to debt. That is problematic. And I think that's part of the discussion is the consumer. They are digging into savings. They are using credit cards. They are even claiming hardship and going to those 401ks. So if the Fed hikes again, are you concerned about a recession?
I absolutely am concerned about a recession. When we look, I saw earlier this week that there was a report that was saying that there was, I believe it was from Macy's, and they're showing more delinquency rates. Well, the reality is that when interest rates go up, we know that if the average American family is digging deeper into their pocket and they're starting to use a credit card, that is a never-ending death spiral at that point, because look at what the interest rates have done within just the credit industry alone, just the credit cards alone. And so it is a big concern of mine that this is the reason why the Federal Reserve needs to halt. If they continue to increase these interest rates, we're going to see further contraction, and that's not a good thing for the stock market.
There's no rush, still plenty of time.
Most of the districts that respond for the Fed Beige Book had seen growth, but there was a slowdown in retail spending. So we're seeing pockets of strength and pockets of weakness, and I guess that's part of the issue. As oil's running up, then you face inflation at the gasoline pump. But I did want to get to what's going on in the transportation industry and the auto industry in particular, UAW. There are some people who surmise that they will come to an agreement at the, the 19th hour or whatever, so as not to disrupt Ford, General Motors, and, Stellantis. And so this is the issue. What do you think is happening here?
Well, it's pretty interesting. First and foremost, I think that the union is really feeling as though they're in a position of control. They think that they have the ability of now demanding, and the automotive industry is going to have to relent. I think it's a fool's errand at this point. I don't really know if the head of the union is just trying to make a name for himself, but he seems awfully demanding, and he seems to think that there's zero negotiation. Basically, they're going to have to agree to all the various terms and conditions. We need to remember that the auto industry has gone broke before. And when we've got more and more of a shift, we've got more and more of an emphasis towards electric vehicles, which we know have smaller profit margins in many respects. I think the auto industry is being pretty honest by coming back and saying, listen, we'd love to do a little bit more, but you know what, we've only got so much to go around, and we still have to make a profit, otherwise we're going to go out of business. So it's going to be interesting to see how it unfolds, but I think that there's a lot of even union workers right now that are kind of shaking their head going, what is this guy doing? He's just taking an absolute no conceding approach, and I think that that's a really, really scary, dangerous thing to do right now.
Well, that does not mean that they settle so fast. I mean, that means some pain ahead. Is that right?
Absolutely. So we want to be looking for, as an investor right now, we know that there's going to be some problems with some of the unions. We look at, the entertainment industry, and we know how much of the actual economy and the GDP that makes up. We're concerned about that. It doesn't mean that those people don't deserve pay raises because they haven't gotten it for a while. We look at the automotive industry, but we are seeing an interesting shift where there's more and more concentration of spending on the service industry, on the technology industry. And here's the part that I hate to even admit, but we have to. Companies are going to eventually come to a position, I believe, Nicole, where they're going to start adopting artificial intelligence and technology instead of human beings because, well, let's face it, the human being they're going to go on strike when technology really won't. And that's the part that we don't really want to see. Yes, I'm all for efficiencies, and I want to see companies be able to improve in that respect. But we also have to be very careful not to replace ourselves.
Yeah. Well, you said if the Fed is not careful, it could break something, right? I mean, that's sort of the phrase that everybody's talking about. Okay. Well, it's great to see you. Matthew Johnson, President, Owner, Johnson Wealth and Income Management. Thank you. Good to see you. Coming up next, our next guest will explain why CarMax continues to gain some market share and why it is a stock you should be watching. Much more on Schwab Network.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not.
Bard was such a low pot, or low stack. Buy out here, halfway to VWAP, over halfway. Slow play. Settings. Gosh. percentage. Hold, what the heck? Spades, the 2. Holding that. I don't know how these guys play. 5, kind of coming down there a little bit. Bluffing, and yeah. Full house. Spades. Nothing. Get the flush. Good fold. Yes. Well, Spy's built this first head and shoulders. See if we break the neckline, if we have room today. 220. 440 left. Crap. We'll play him. Bites you. Minutes to power hour. See, still flushing, dude. When will the share offering be over? It's down 33% to $9. Volume today. 6 minutes.
$96 price target. Oppenheimer has a $105 price target. It's at 81 and change today.
34%. AMC's breaking through the lows.
CarMax and the used car prices.
Flush a little bit.
People maybe can't afford or don't want to commit to new cars, right? Because the rates for financing will be higher. Big commitments to fork it over for a new car. In the meantime, last but not least, what do you tell folks? Because I know you have a long-term outlook. I think that people are expecting some volatility here in this last part of the year, but are you telling them that you feel optimistic about 2024?
Yes, 2024 is shaping up very well. I mean, the Fed's done a splendid job, actually surprisingly good job of bringing inflation down where it is. We're hopeful that they simply complete the job. And if so, we may continue to see an uptick in unemployment, which is good because it means more people coming back into the workforce. But, you know, the average Americans had about a 4.5% average annual wage increase over the last year, their personal consumption. So U.S. consumers are in pretty good shape. We just need to get into 2024. But we're very excited about the opportunities we're seeing today.
Yeah, I know the Beige Book said it was like one last hurrah for spending.
Like Spine's building up some strength,
maybe.
maybe.
See what they choose to do going into the fall and winter. David Rainey, thank you so much. NSE Focus Fund, thank you.
What move?
Coming up, you're watching mortgage rates, highest point really in 20 years. So let's dive into the real estate market next. Dolly Lenz, Jenny Lenz, coming up.
Ace. Oh, I got lucky on that river. Holy smokes. Fly popping up there. What the heck? Wait. 4 ace beats my king jack? Is that real? Ace 4-4 king kicker. Oh. I guess I didn't realize that. Just because the one pair is higher? I guess it made sense someone had an ace there. I thought I landed it once I got the 2 pair, but no such luck. I climbing up to VWAP. Barbecue down almost 6 now. Really wanted to hold this trend. Might be a little salty if my rips past VWAP. Takes it back to high day. Warming a big cup. But if it just makes the VWAP, I'm fine. Those are my parameters for saltiness. There we go.
Probably paid, 18% or something. But what kind of environment are we in right now, Dolly?
Well, the good news is that even though it's very high, it feels more stable, right? To your point, that before it was 3, 3.5, 4, 4.5, 5, 5.5, and just keep going up.
Yeah.
And you don't know how to plan.
Right.
Right? At least if you know it's going to be 7 or 6.5, you can plan. Can I afford this house? What am I doing? How much can I pay? It's much better for people when they can plan and they know.
The Fed said that they wouldn't raise probably the benchmark interest rate much more, right, which directly affects mortgage rates.
Right.
And before, as Dolly said, people were rushing in, going to buy a home, thinking that the mortgage rates are going to increase significantly, or they were just paused and frozen, not knowing what to do. If we know it's going to be around 7%, maybe 8%, you can manage that and go forward.
And, we had mortgage apps at the low, basically 27, 28-year lows. People just basically took a pause.
Yes.
Because prices are still relatively high.
But some of them are forced pauses, right? There's nothing to
What,
buy.
they just fully even check.
Right. So do you expect the tide to turn, Jenny? I mean, are things looking better? Because there was a time, maybe 8 months ago or so, you came on, it wasn't feeling so great. Are things feeling better?
I know it's a bad hand.
Some nervousness?
Yeah, so for the first-time home buyers, again, that's going to be difficult, right? High mortgage rates, high pricing, high median home prices.
Yeah, I'm 11.2% to win. The players are 13.5, so odds are not in my favor.
In the form of mortgage rate buy-downs, in the form of discount home prices, money back at close. They'll pay some of your maintenance, right? And that's probably why the Warren Buffett decided to invest $800 million in
He was big blind, he just folded.
D.R. Horton, Lennar,
He knew
and
I was a
NVR,
force to be reckoned
so
with.
he's seeing obviously a big uptick in home building sentiment.
Yeah, I mean, I had some concern about pricing and affordability. I'm glad you brought up Buffett's investment because that has helped. People like to invest like Buffett, and when they see names like D.R. Horton and Lennar, and NVR, it's a good point.
And those three stocks, by the way, are up over 30% year to date, whereas the S&P 500 as a benchmark is only up 16.3%. Right. So
I mean, but the home builders overall, when you looked at the home builder ETF, even before we heard from Buffett
almost a
and those
VWAP.
investments. It just it was
It's a
like
bright
scratch
spot.
my head. I mean, I almost couldn't understand how they were doing so well when things weren't really moving. But now, I guess inventory is improving. So tell us about that. Number of days on the market, inventory. But I would like to know about affordability.
Well, affordability is at an all-time low.
You made some good points on the home builder discounts.
Yeah, affordability is an all-time low. There's no question. So people really have to dig deep. What am I doing to be able to afford this home? Am I taking a second job? Am I sending my wife or my husband to work? What are we doing? How are we going to pay for this? Or am I getting a side gig? Whatever it is I'm doing, I need more money to buy this.
Yeah.
And people are really working on it to get it done.
Right, and days on market are higher. In July, they were 20 days versus last year, 14 days. Right, so things are taking longer to sell. People are pausing a bit, right?
And
to
a
VWAP.
bright spot in
There
New
it is.
York potentially could be this whole Airbnb rule, right?
Yes,
that's going to be enforced.
To ask you about that.
Yeah, so that's great for New York because it's a loophole. Like Airbnb is a loophole. They don't pay occupancy tax, right? So if I stay in a hotel I have to pay a 20% occupancy
That
tax.
annoying daily fee that you see on your bill. Yes.
Yeah, exactly. Where if you stay in an Airbnb, you don't. It's kind of like the loophole that Amazon had with sales tax for so long, right? If you bought on Amazon, you didn't pay sales tax. If you bought in a retail store, you did. So it's wonderful because people probably will have to sit there and say, I can't afford to keep this. I need to sell it.
So in the meantime, you know, I appreciate a crackdown like this because I think it does keep transients out of the apartment buildings. There, you know, there's crime. More concerned about crime if you have people coming in for 2 days, 2 days,
that you don't even know,
and they're not even supposed to be there for 2 days. Right. The rule is 30 days. Right. And it's supposed to be 2 occupants, and if it's going to be 30 days, the main tenant, the main
must
owner,
live there.
You know, has to be there. There's
Which is very weird. You don't want to live with, you know, someone else.
Nobody's going to do that. I agree. It is weird. And then, you know, New York is sort of saying to Airbnb, why aren't you cracking down on the violators?
Exactly.
And
I think that's
they will.
Right, and as of September 1st,
Will
apparently
they?
they're going to. Because the listings aren't online. They can't be online, right? And the fear...
Unless you obtain a license.
Exactly.
Right?
But the fear is that this will happen also in Austin, in Houston, all these places where people wanted to become kind of mini moguls, right? And rent out, buy these places, rent out these properties, right? If they can't do the Airbnb that they thought they could, right? They're going to have to sell, which could be a good thing in the end.
Which will free up inventory.
Exactly.
Because
We're going to have a market crash if Airbnb gets shut down.
I mean,
It'll be the catalyst.
What do you think about New York City as far as commercial real estate, residential?
Wow.
I mean, where are we talking here?
Commercials in a no question death loop, right? What the Wall Street Journal reported today, it's absolutely a death loop. Every day, basically that whatever you're valued at today, $300 million for your building, you can't get financing to refinance it that's coming due now. So it's not worth $300 million because you can't get financing. And what are you doing? You're taking in investors who are going to be in much lower than the $300 million valuation. So it's $200 million.
So you're taking a loss.
And not only that, but the banks have this on their books. And the banks, if they have to mark to market in any way, shape, or form, they're not going to pass tests. That's the disaster.
Remember we were talking about the regional banks and you know, when we had the collapse, and then you were talking about how folks were trying to get mortgages and you were working with some of the regional banks. How are you finding that to be as people are trying to get mortgages? How's that going? The credit crunch, or is it loosening a little, or is it
not
still
loosening?
hard to get a mortgage?
Very hard. Very hard. AAA credit, you know, really good asset. You have to put a bigger down payment. All things that are against
I mean, there are a lot of headwinds, right? Insurance, especially in Florida and California.
And that has gone up a lot. Everywhere. Insurance has gone up.
Here too, but more so in places
like flood insurance, for example. You know, let's say last year in a building in Florida might have been $100,000 a year. This year it's $1 million.
Did you
10 times
the articles? I'm sorry to interrupt you. We have to go, but there were articles about people now just bypassing insurance altogether.
Oh,
they're self-insuring. They're just saying,
we know
I
a
can't
lot of
afford
people personally who did that. But on the Airbnb, we're getting calls. They might want to list their properties, so we're excited about that.
You just call,
so it's already coming in.
So come back soon.
Thank you so much. So great to see you. Happy almost fall.
Raise of $5,000 was brutal. Oh, he called. What the heck?
We're both here today. Lots of hot
With a
topics
good
in
hand.
the real estate market. Glad we got to cover at least some of them. All right, still ahead in the second half of our show, Tyson Foods will start delivering some of its products with autonomous trucks. The CEO of the startup and Tyson, we're going to
see if they were slow playing me. I was checking it through one time.
And we break, take a look at winners and losers in the S&P.
But yeah, in hindsight, I guess I could have raised more there. But I don't know. Nice to mix it up. Raise sometimes there. Slow it down sometimes. Right. Okay, mine's back to the UAP. GME 5.6. GME is only down 1.7 now. Still flirting with that line of resistance. Earnings, maybe not an earnings call, but they're what, 10Q? 10K, whichever it is. SPY breaks VWAP, and we could see up being built here. I don't have enough time today. We've got what, an hour and a half left. Find buying power if that's the case. Where would you be? Where would I be if I was buying power? Where would I be hiding? Where? Dang. Watch this one. How was that half? Oh, that's all in. Like, how was that half the pot? Oh, that pre-flop was huge. Whoops. Not paying attention to my back. Yeah, I know, I could have lost on that all in. I didn't realize how much went in pre-flop.
I did mention the Nasdaq's the only one that's above it, but as you take a look at where we are relative to last month's highs and lows, I think this kind of helps us put this move that we're seeing here today into perspective, right? It's not as big as it seems. We're still kind of hanging out in the middle of the range that we established in the month of August. And I did mention that 50-day moving average. Here's the S&P, is a pretty good snapshot and a look at what you'd see if we had the Russell, if we had the Dow here, again, all three below it, holding well above the 200-day moving average as well. But let's keep an eye on the Nasdaq, because last I looked, it was only about 15 points, 20 points above that 50-day moving average. And again, just a lot for investors to deal with. I've been saying these are all straws on the camel's back. It seems like it's starting to bend, I guess, is one way of putting it. I do want to keep an eye on those lows that we saw last month, though. Take those out. And again, we could see some energy to the downside here. But as long as we're within the range that we established last month, all of this still is relatively contained.
Understood. And you mentioned, look, you had the 2-year above 5%, right? These are the different things, the oil running up, the dollar running up. And that's what people are watching, right? The dollar near the highest level since March. Oil really around 10-month highs. I mean, let's focus on oil a little bit. That's something that, and it closed higher again today, slightly.
Yeah, it's been on the move, and that's definitely going to raise some eyebrows. It's going to pose a bit of a headwind for stocks to the upside, and it's one of those straws that I just mentioned in terms of that camel's back that we were talking about. And you can see recently up to 88, right? This is not what the inflation hawks want to see. It feeds directly into some of those inflationary pressures the Fed Chair Jerome Powell and his team have been dealing with. And definitely, the one thing I can say is that it doesn't seem as if prices at the pump have really started to escalate to the same extent that we've seen crude prices. Taking a look again at the last couple days of price activity and the run-up we've seen here this week, taking a look at
Bays
how it's
is
not
up
just
10.
this week and some of the movement we've been seeing. This goes back to the beginning of July
Bays.
when we were down around 67 and now up around this $88 level. Brent up to 91 here. So I'm definitely keeping an eye on prices at the pump as well. They haven't really accelerated to the same extent, but we were talking about the S&Ps dipping back down below the 50-day moving average. Look at crude oil. If higher today, it looks like 6 in a row to the upside. It looks like 8 out of the last 9. We're back to levels we haven't seen since the fall of last year. You mentioned the strong dollar. This comes with cuts from OPEC. A supply shortage ultimately is what we're hearing about. And even with strength in the U.S. dollar back to 105, it doesn't provide a headwind. But I did want to point out one last chart here, Nicole. Crude oil and the S&P is bringing those two conversations together. You can see how they track each other very closely. The purple line is crude, the candles S&Ps. Quite the divergence that had just recently occurred, but you can see, again, history repeating itself here in this instance. It doesn't really diverge for very long. You can see crude oil starting to narrow that margin here as it runs up and, again, back to 88 in the WTI.
Yeah, understood. Okay. All good things to watch as this week progresses. Thank you, Ben Lichtenstein.
Lichtenstein.
We have some big news, breaking news in this whole industry when it comes to foods and autonomous vehicles. Tyson Foods announced this week that the company will start to deliver its products to distribution centers in Northwest Arkansas with fully autonomous trucks. And that is thanks to a partnership with Gatik. Gatik's CEO and co-founder Gautam Narang is
What's
with
Gatik?
us, and Tyson VP of
You and me, buddy?
Transportation Patrick Simmons. They both join me now. Thank you both for being here. Gautam, this is something that you must be so excited about. We're talking about autonomous trucks, refrigerated trucks. Is this a big leap for you now and a good point? Because I know you already have partnerships with Kroger and Walmart. The more and more people learn about your vehicles, this is good news for you, right?
It is, and we're super excited about this partnership. I think what's unique about our
Dude,
partnership with
who's
Tyson
Gatik?
is this is the first time Gatik is introducing Class 7 box truck platforms. And
Another
these
random new
Class
EV
7
company.
trucks allows us to continue disrupting some of the routes that were traditionally served by Class 8 tractor trailers. And with this addition of Class 7 trucks, Gatik is the only company in North America that provides Class 3 to Class 7 autonomous solutions across the different supply chains.
Is that electric? No, that's not electric.
I mean, not everybody understands the differences between Class 8 and Class 7, but we know you have it covered. And before I get to Patrick, just to clarify, I mean, these are autonomous
I just don't want another club to come out there.
They're refrigerated trucks.
Like to everyone else.
Is there a driver in there?
So we will have safety drivers initially.
Maybe these are,
These
they're
the
autonomous.
trained professionals that are
Are they autonomous
responsible
gas
for
trucks?
overseeing the autonomous driving system. And once we have proven the technology and validated the technology on these new routes, is when we'll basically start the transition to driver out in a commercial capacity.
The re-raise would be
And
so
just
obvious.
To flag, Gatik as a company goes after this mid-mile segment of the supply chain. So we automate light and medium-duty trucks. These are Class 3 to Class 7.
Keep melting it a little
And
bit.
the best part about our use case and the application that we're going
What
after
happens?
is we get to operate these trucks back and forth on fixed and repeatable routes. And with this constrained focus, we are able to get to the point where driver out faster
Yeah, I
and
like
safer than
that.
some of the other applications.
I mean, Tyson, a meat giant, generates $50 billion in sales. I mean, we know all the great Tyson
Come on, baby. No one's
products,
gone.
Patrick. I mean, when we think about Jimmy
Gonna
Dean
get
and
all in on
Hillshire
the river.
Farms and everything, this is an
Crap.
unbelievable leap, isn't it? Maybe supply chain efficiency, but a whole new world, Patrick.
Yes, good afternoon, Nicole. Thanks
I
for
wanna-
having us on to talk about it. We're excited about the new automated truck.
What's the
For
min
us,
bets
a
here?
lot of times when people hear about it, they think it's going to do away with truck drivers. Reality is there's a truck
can't
driver
believe
shortage
that
that's only
club
been
came through.
amplified by the COVID pandemic crisis, and that has not gone away. It existed before, and it exists now. This allows us to the partnership with Gatik
Guys play super
to
aggressive and all of a
strategically
sudden.
place our drivers where they're needed most. Some of the longer haul running, we can get more efficient and turn
That would
or
be
sweat
awesome.
our assets
Um,
with the truck, trailer,
no, I'm
and
not
driver
practicing for
better than
TV
what
show.
we've been able to do in the past.
Well, you said, Patrick, I've read
That's
some
pretty
of
funny,
your
though.
comments about short-term haul. that truck drivers and the shortage of truck drivers, they don't really look for this particular type of job. It's a less desirable
10
route.
minutes to power hour.
And these trucks can haul Tyson foods 18 hours a day, Patrick?
Yes, so
There's gas as
we're
Zuzus.
going to put the Gatic vehicles on what I would call our shuttle run. So from production
Pretty strong,
facility
yeah.
to a finishing plant or a cold storage distribution facility. Typically, those are
Right.
15 to 20 miles away from the production plant. Drivers, human drivers, don't typically like to do that because it's in and out of traffic, stoplights, those type of things.
Of course, this is what's
By partnering with Gatic and utilizing their
Put me on.
technology
Do it.
and the vehicles that they have, that allows
heck,
us
a
to
minimum raise?
repurpose our truck
Who
driver
are
to
you?
do what they do really like to do, the highway driving, 300, 400, 500 miles. That driver that was doing the short
Accident went all in.
shuttle
Oh well.
run is now able
My
to do
card?
about
Nothing.
700 loads across a year that we were not
A
able
pair
to
of eights on the
utilize
river.
long
Nice. Well
before.
done.
And that's, I'm talking our private fleet drivers, so we don't have to utilize another third-party company. We can repurpose our own internal asset and driver.
I just can't believe it, you know, and I know Gatic has a great safety record, but I can't believe my ears that I hear that this is actually really happening. I think that we've heard a lot about the ideas, and now
Not
it
getting
really
bad
is
hands.
happening. It's wonderful
There's some good ones
to
in there.
chat with you both, Patrick Simmons of Tyson Foods and Gautam Narang of Gatic. Thank you. Still ahead, we'll take a closer look and look at these semiconductor
It's hard
stocks.
because
Of course,
I
we
keep
have
coming in with
ARM in the new IPO.
way
It's a
down on the
$52 billion
chip stack.
IPO. What's
Just a hard
happening?
position to be in.
Coming up, our
And
panel is ready.
land some all-ins. And people are playing really tight. Oh, Spy's wanting to do it, dude. Dang. It wants it for power hour. Wants the push. Trips came in. Wow. It's hard. It's hard to get down on stacks. Just because I have nothing. DFS down 4%. Anyone buying the dip on this thing? I'm getting ready for a power push. Guess I'll double up with high card.
What's next? Where do you see the great companies or the best growth?
2024 is going to be a real critical year for PCs, specifically laptops, some new form factors. And what I mean by that is we're going to see a very big shift in architecture from Intel as well as Qualcomm. In their types of processors. Qualcomm is they're set to announce Orion, which is their next gen processors. That'll be later October in Hawaii, which will be a nice press event. That chip, though, is interesting because Qualcomm currently licenses all their chips, all the Snapdragon stuff from ARM. They bought the company that used to build the chips for Apple, the same engineers. They formed a company called Nuvia. Qualcomm bought them. That means Qualcomm right now is building a chip that doesn't rely on ARM. And this long term could be a really interesting downside to ARM if this catches on. Because if Orion is good, and I am hearing it is good, it can really damage the business of ARM long term because smartphones and laptops will eventually start using those. As far as Intel goes, Intel's going to have a big shift in their architecture too for their processors, and this will actually compete with Qualcomm. So I'm really excited to see in 2024 who has the better efficiency, who has the better power management, and all that coming to laptops and all our cutting edge devices that we use.
All right. We'll have to leave it there. Thank you both so much. Daniel Rubino, Windows Central. Angelo Zeno of CFRA. Thank you, Angelo and Daniel. That's going to do it for me. I'm Nicole Petalides. Thanks for joining me here on the watch list. Keep it right here. Market on Close is next.
I was born on the south side of Chicago. It has been a long road.
This is hard with low chips.
I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us.
Hold around. Dave & Buster's earnings today, yeah. Look at that, coming right into that gap fill. Wait, did they already have it? Oh, it's after hours, right? Got Dave & Buster's and big sell-off on Dave & Buster's to theirs. Oh, Playing the smallest blinds in that game too is like people just play whatever. Don't take it quite as seriously, so a little harder to play. People just go all in frivolously, call anything, and once I get to I do the higher blinds, it's better. Open door. Open AI dumps on it. A dump. Decided? Yeah, exactly. Going all in when I shouldn't. Playing less conservative. But that's because I had a smaller chip stack. I don't play that way when I'm more matched up. I end up like 1, 2, 3 million. I had like 100,000. I wouldn't be doing that if I was the leader. Or even in the middle of the pack. BBBYQ's holding that support still. Hour.
Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. We have 1 hour left in the trading day. Stocks having a little bit of trouble here. We got a pretty hot ISM print earlier this morning that sort of put the inflation problem back center focus as concern around that has been building following the economy's recovery this summer and into the fall. Summer's over. Sorry. It's time to start thinking about what comes next. And typically, volumes pick up a little bit here. And historically, it's not a great time of year for the stock market. Just kind of the way it is. September, October, not the best seasonality. Lizzie and Saunders might tell us a little bit about that. We're going to have Kevin Gordon on in the afternoon, joining us in our panel alongside Michelle Gibley. So the Schwab team is going to give us a good rundown here, what they're thinking about heading into the rest of this week. Things are already getting pretty busy as bulls having trouble with their narrative. We've also got those
coming down there.
Items to keep sentiment elevated,
Below
including the big
VWAP.
ARM IPO that has a lot of excitement around chips and the future of tech. We're going to talk about some of that as well. And we're going to be looking at some earnings this afternoon. We're waiting GameStop, see if there's any update there on their strategy. Shares coming into that report down at the lows. And last time around, stock peaked out right after its earnings. So we'll keep an eye on them this afternoon. The highlight of the session definitely, though, is this morning's data. So let's go there. And my movers, the most important thing I'm watching continues to be the dollar next to crude oil. WTI's move looks pretty persistent. It's just not giving up right now. The move continues with the rally today of about 1%. That's happening even as the dollar is up. Now, that is not the way it's supposed to be. Dollar moving higher with crude kind of violates your textbook economic and trading assumptions, but it's what happened throughout basically all of last year. So it makes sense here that stocks are getting a little bit nervous about some of these inflationary implications. Crude oil's breakout is just picking up steam. If you look at the bottom panel, that's the relative strength. You can see the move into overbought territory there on the right side. As Mr. Chartmaster Rick Duquette likes to frequently remind us, overbought or oversold definitely does not mean that it has to stop going in the direction it is. Many times it means it's heating up. In fact, the last time we got it was right before crude oil peaked out, but it still had about 3 weeks left in the trade earlier this summer before it hit that peak. So when you're getting overbought, that's really when the momentum is picking up. And that's basically what's happening right now. It looks like the breakout is the real deal. If you look at what's happening in the dollar and the response by markets today to the hot ISM services, it was a little surprising that we haven't extended it, but we did get the pop. We got the pop in the dollar, you see there in the white. We also got the pop in the 10-year yield. Dollar's not exactly running away with it, but it's still staying firm. All of these things are pointing towards a harder decision over the next 3 months for the Federal Reserve. Market has had the odds of a hike around a coin flip, but less, around 40%. If we keep getting data like we got this morning, then we should probably expect those
Coming down
odds
some more
to
there.
move back towards a coin flip, closer to a 50-50, maybe even above it. Only about 3.5 percentage points were added on to the possibility of a hike by the December meeting, according to Fed Funds Futures. But just know this is the way it works. At least it's not hard to figure out. Data come in better than expected, dollar goes up, interest rates go up, and the odds of the Fed having to hike go up. Until we hear otherwise, and the commentary so far has generally been pretty soft from Fed speakers that are on the schedule this week. But we should expect to hear something different in their tone because their GDP expectations are likely too low, and the bond market's telling them that the economy can probably handle it. Over the last 30 days, the yield curve we're looking at here, 10-year -2s, has still expanded on net. Now, granted, it's getting a little bit pinched here in the last couple sessions as the market is starting to price in perhaps a little bit more aggression on the short end, which means Fed aggression. But still, the labor market has been strong enough, the data have been surprisingly strong enough to keep long yields rising faster than short yields. Now that's probably going to change. This curve is probably going to start to flatten out again if the Fed starts turning a little bit more hawkish. But the status of it at this point is telling us that the economy is withstanding the pressure that the Fed has already put on it and hasn't buckled, hasn't broken. Never before has, in a recession, the yield curve inverted and then uninverted by steepening the way it's steepening right now. So there's all the fear about what the inverted yield curve means because in history it's always preceded recession. That's true. But it's also always uninverted because the short end goes down while the Fed cuts. And we're getting the opposite. That is the market telling us that the economy is strong, inflation might be a problem, but if the Fed has to keep fighting it, it should be okay. Shouldn't break things. All right. Also, watching VIX and volatility. VIX is down near the lows. And this is where the market does seem to be a little bit out of whack, frankly, because VIX at 14.5, near the lows of the year, speaks to a bit of complacency. If the major threat is inflation, if the threat to stocks is higher interest rates, you probably think VIX would be a bit higher, considering the way things are developing right now on the inflation front. Let's bring in Kevin Hanks and Renita Young. Help me walk through some of the action from this session. Stocks down about 1%. Kind of near the lows here right now. Kevin, what do you think? I mean, we got the dollar up, but not a ton. Overall, it seems like it's been a fairly measured response to ISM services because when those numbers came through this morning, showing employment, showing new orders going up, not just beating, but going up, I thought for sure the dollar was going to take off like a rocket.
Well, if you ever want to know what makes a market move or when does it move, look at the 9 o'clock 1-minute candles on a lot of these major indices. The dollar, yields, some of the indices. They all moved at 9 o'clock, Oliver, when that number came out. Remember, when I was on with you early this morning, the dollar, yields, and crude oil were all lower. So now crude oil, that's a microeconomic, right? They've got their own individual story. But the macro, the other ones, when that ISM number came out, dollar rallied hard, yields rallied hard, and the market, all the indices moved sharply lower around that 9 o'clock Chicago time, 10 o'clock Eastern. So The market didn't like that number coming in so strong there in the ISM. So that was one of the reasons. The markets were already down when that number came out. And that being said, they are, in most cases, off their lows of the day and recovering slightly. The VIX, it was higher. All the indices were lower, although they're drifting back down here as we get through the 2 o'clock hour. So it should be an interesting final hour. But Oliver, right now, when I sat in the chair to talk to you, we had energy and we had utilities higher on the day. That's not the case anymore. All 11 sectors of the S&P have now gone negative on the day. So this is getting a little more broad. You see 7 really big boxes on that S&P 500, that Magnificent 7, all under pressure today. Very difficult for the dollar to be higher, yields to be higher, the Magnificent 7 to be lower. It's going to be a tough, it's tough not, to try to turn that momentum around on the downside. We'll see if it does, but all things considered, still a calm market. Wouldn't call it you mentioned the VIX, wouldn't call it an aggressive sell-off here.
Yeah, VIX pretty calm, still down to the lows despite this. Interesting today that we did get tech responding to rates, it seems, where yesterday when rates were moving, the banks were selling off more. We do have the regionals down again today, but tech joining into the downside. We did say yesterday it was a little bit odd that tech held up so well. Tesla was kind of carried it on its back, though, so we had that going on. Energy to lose that as the leader is discouraging because now the breadth of the sell-off is widening out, and that's the one group that's working. But it's creating complications as crude oil goes up. Starting to see some of that with some of the airlines, it seems like, Renita.
Absolutely. So when we saw a few large producers extend their output cuts to the end of the year, that sent a ripple effect through industries that rely on fuel. And one of those is the airline industry, and several of them today are warning that their fuel costs are going to go up in the third quarter and maybe even beyond because of this largely. And so that's why we see the JETS ETF. It is lower today by about 1.2%, and it would be the 5th day of the losing streak. But it's still up around 9% year to date. However, that is definitely underperforming the market, but it's down about 17% from that peak that it hit back in July, which is also considered during that peak summer travel season. July 4th is another big weekend that people travel, right? But one of the companies, Southwest, said that last-minute leisure bookings fell short of the expectations for August, and several other issues, like they were one of the companies that said that fuel costs are going to rise during the year. They're expecting $2.80 at the high end per gallon of gas. And they're also looking at another low-cost airline, or another airline, I should say, is looking at its outlook for available or revenue per available seat mile. When it comes to Southwest, though, it cut its third quarter outlook for revenue per available seat mile. United Airlines, they hiked their fuel estimates to $3.05 at the high end, but they stuck to their revenue and cost guidance for the year and for the next quarter. Alaska Airlines raised their estimates for third quarter fuel costs to $3.25 a gallon at the high end. But those last minute bookings for this company remain strong in August. So it's interesting to find out which of the airlines are doing stronger in which of these areas when it comes to the expectation of fuel costs to rise, how well they did with last minute bookings, right? And how well they'll do on revenue per available seat mile.
It feels like that's kind of the catch with investing in the overall sector, is there's so much competition, and there really are some real differences in between each carrier. Southwest, their outlook for the oil price is a little bit lower than United's. They kind of have that reputation as being able to handle a little bit more of an oil rise. But then United's got the bookings to go with it. Then you mix in analyst notes. They're trying to pick winners. And this morning, talked about the bullish note out on American, which has a bunch of debt. So then whenever rates go up, American always suffers. And that stock's just been getting killed the last 3 weeks. It seems like that's also a story that we can't forget, too, for airlines, Kevin, is that rates do matter on the more indebted ones. And as soon as rates break out, it's like American drops to the bottom of the pack.
You're right, Oliver. You can talk about this group as a sector, but then that sector takes on several different stories within that sector. When you look at American, Boy, every plane that seems to go over Chicago seems to be an American plane, but their balance sheet struggles. Southwest, they may not have the same gasoline exposure because they're more domestic. They're taking more short flights than, say, United that's going international in Delta. So every single airline has a sector, and then they have their own individual stories. So, yeah, here's the one last thing about airlines. They're volatile when times are normal, Oliver. These stocks really move. So in times of uncertainty, look out. They move a lot.
Okay. Quick last thought, Renita.
Interesting thing about American, they were raised today to an outperform from a neutral over at an analyst, and they boosted the price target to $20 a share.
Yeah,
I think that's
the one.
interesting considering all these warnings coming out, right? We were looking at this, and it was BNP Paribas who raised it. That's around a 38% or so move to the upside.
Move. It'd be a fresh one-year high for American.
It would be, but who knows if it can make it there.
It's kind of a good
That
example
bounce on the 50 moving average for SPY.
22 of markets right now. We've got a strong economy.
45 minutes to
people in
close.
America, they're still traveling for sure. I mean, they're
GME back down to
pretty
VWAP.
unabashed about spending right now. But then the inflationary pressure on the profits gives you this back and forth and makes it a very tough investment. So I guess you're not mad if you bought airlines a year ago, but it certainly has been a very wild ride and a good place to watch as we see the oil impact here broaden out to the macro economy. Thanks for the perspective, Renita and Kevin Hanks. Good stuff, team. All right, let's talk some macro here.
Oh, there's a dividend sell-off.
Joining us to talk a little bit about how the inflation potential here might stagger the economy.
Why is Lockheed
Not a
selling
big
off?
believer in the soft landing. Joining us from Monticello.
Lockheed joint venture enters weapons.
Ollie, thanks for being here on the show. Welcome to the Schwab Network.
Oh, cut
Thank you very much for having
F-35
me.
jet
It's very
delivery
nice to be
outlook.
here, Oliver.
Appreciate that. I like the content of your notes you sent over because it gets basically straight to the heart of the subject, which is whether or not the Fed's going to be able to thread the needle right now. And it seems like our economic projections keep getting ratcheted up, but is that good news if inflation gets ratcheted up alongside it?
Well, that's the key point, which is why are the economic growth number are being ratcheted
Jeez,
up.
AMC down
And
37%.
At Monticello,
And
we see the
848.
federal deficit spending to be a big driver of the economic growth in the current year. We expect the deficit to balloon to around more than 7% of GDP, depending on how they account for student loan forgiveness and cancellation of it. But at 7.5% of
Upside
GDP compared to an average post-World War
Albright,
number of
Montpellier,
3.5% of GDP in deficit spending.
Montpellier,
Essentially,
that's insane.
It means that
Never
much of the
seen those
economic
letters together
expansion
like
that
that.
we are experiencing in 2023 is driven by increasing federal spending. And essentially the bill for that is going to come due soon. That will be in form of both lower growth as well as higher inflation in the upcoming months.
Now, is this just from the so-called Inflation Reduction Act? Is it from the government's response to regional banks this year? Is it almost like a sleeper under-the-radar stimulus that's happened over the past 10 months?
It's honestly on both sides of the government's books. Both the revenues are coming lower than expected. For example, if you look at the tax receipts are below projections. Part of that was expected because capital gains taxes were going to be lower given the way markets performed last year. But on the other side, if you look at withholding tax receipts, they are also showing anemic growth. They are not consistent with an economy that's adding a lot of jobs. And it actually begs the question, how accurate are the jobs number? We saw this Friday that there was a revisions in the prior months. If you look at, for example, June job data, it initially came, if I'm not mistaken, at more than 200,000 jobs created in June. And by the second revision, it has gone down to around 100,000. So it's essentially was cut in half. And coming back to your question, what's driving the deficit spending? In our view, it is on one hand lower taxes, on the other side, combination of really three bills: Inflation Reduction Act, as well as infrastructure bill and CHIPS Act. If you add all of them up, you suddenly get to a point where essentially a lot of expenses on the government side are growing faster than expected.
If the expenses and money that's being outlaid into the economy is targeted in the right place, though. And obviously, that's a debate to be had. But at least it's a little bit more specific, it seems, the measures over the last 8 months compared to just helicopter dropping cash on the American public like we did in COVID, I would think. So, I mean, I guess argue that point if I'm wrong. But if I am right,
Dobré odpoledne.
possible we could have a scenario where, yes, inflation sticks around and inflation maybe is an issue, but we don't have to have a dramatic stagflationary environment where the prices remain high, but then the activity drops off a cliff.
That's exactly your point. Exactly. It depends what the money is being used for. There is a difference between helicopter money versus money going to the right places. And that's a debate to be seen. We don't have a strong view. What we are seeing, though, is the outlook is worsening. And then the other sleeper that I think is there more than the direct government spending is on cost of debt. What we are paying for debt service has grown dramatically. Actually, last fiscal year, Federal Reserve was sending $100 billion to Treasury Department. This year, that number has gone to zero because, if anything, Federal Reserve is losing money on its portfolio of long-term government bond holding. And I think U.S. government had a honeymoon period between 2020 and 2022 where they were able to issue debt at a negative real yield. Essentially, the cost of debt service was fairly low and inflation was much higher than what they were paying for debt service. So you would not see too much instability in the growth of the debt to GDP. Now that's being reversed. Now, in the current year, over the past few months, as more of existing government debt comes to maturity, and then government is going to issue $2 trillion of debt over the next few months, you'll see the cost of debt service go up, and it could get to 25 to 30% of federal receipts being spent on interest on government debt.
Now, within all of this, the dollar has managed to reverse a breakdown this summer and start to firm up, though. If the Fed stays on inflation and doesn't get scared off by slowness in the economy, does that prevent us from having a major kind of deficit-driven disaster? Because if the dollar stays up, we can still kind of throw our weight around, right?
Yeah, it's an interesting point. If dollar stays up, on one hand, you can see it benefits the workers. It actually is anti-inflationary. It can be on one hand have a lot of benefits for the economy. On the other side, if dollar stays strong, it becomes harder for government to pay its debt. I mean, essentially, historically and traditionally, the way sometimes sovereigns have been able to manage their debt without having a default is by devaluing the currency. And if dollar stays strong, that burden of debt to GDP is going to grow at a faster rate. And that's essentially the conundrum that the Congress needs to address. If we are going to have positive real interest rates and the debt to GDP is going to grow, the solution is either cutting spending or increasing taxes. And that's something that Congress needs to decide how best to address.
Okay. Good to get a baseline of framework for the way you think about things. Ollie, let's definitely be in touch. Keep the conversation going.
Thank you very much for having me. It's an honor to be here, Oliver. Thank you.
Thank you very much. And a good convo here on the macro front as we begin our conversation this afternoon, thinking about the reasons for elevated inflation, deficit spending, argued by Mr. Melly there from Montichill Partners. When we come back, let's talk about the excitement around the tech world, which is still riding the wave of the AI trade. And ARM's IPO might be arriving at the right time to inject some positivity into this market.
All right, Jay. Thanks for hanging out, man. Thanks for the Oldham tips. You gonna come by for earnings?
save the day as ARM expects to debut with the multi-billion-dollar IPO. Jack Ablin's with us this afternoon of Crescent Capital, Chief Investment Officer and founding partner. Always great to have you here, Jack. Let's start by talking about this IPO. What meaningful impact
Pretty hype on this IPO.
Right now?
I'm an awful time to IPO though.
Yeah, I think it's going to be a huge test on the receptivity of
IPOs on Discord?
IPOs on this market. You know, IPOs have pretty much been left for dead ever since last year.
Just get it on your phone.
Rates went up and markets
Probably
went
much
down.
easier just as an app.
To have an IPO
Download
this size upwards to $5 billion is a big test.
Get an account, get all set up. And
yeah, it's certainly looking a little bit dicier than it did, coming into the month of August, and we were only 5% away from the all-time highs. Is there a possibility that they would pull this back if we drop 10% between now and whenever they're expected to do this, which should be this month?
Yeah, right now it's still debatable what their pricing valuation is. I kind of have it surrounded, if you will. They're talking around $50 billion.
What the heck I raised?
As their potential market cap. But if we keep in mind that NVIDIA had agreed to acquire the company at $40 billion, so we know that's probably a low end. And then the company bought back shares from SoftBank recently, and that was around $60 billion, that valuation. So I think having this, around somewhere between 40 and 60, we're talking about 48 to 52 is the current pricing, is probably where they're going to end up.
Yeah, we're looking at the chart here. I mean, that would be a big number if we hit, anywhere close to 50 billion, given that it's just like, all quiet on the IPO front here the last year. Pretty crazy, especially compared to how it was during COVID, of course. Do you think some of this is fueled by what happened in the semiconductor AI trade the last 6 months?
Yeah, I mean, it's really undoubtedly.
You call anything
the fact is, this is motivated by SoftBank's need to raise liquidity, certainly. This is a strategy that's been troubled, all the way back a couple of years now. So they are looking to reposition. They are looking to raise liquidity. But I also think they're tapping into this huge enthusiasm for AI and having a chip that appears to be like NVIDIA, which has certainly been hundreds of percent this year. Last earnings season, last earnings report blew the doors off expectations. If they could get even a shadow of what NVIDIA's calling for, I think they're going to be in good shape. Now, that said, they are also trying to price it at a valuation that's pretty darn close to NVIDIA. And NVIDIA is a proven player. ARM is not.
Yeah, good point. Generally speaking, too, the chip comeback based on the AI breakthroughs has lifted valuations back to the very high end for tech. I love the chart that you've got in your research that takes each sector and places the current price to cash flow. Is that what you're looking at here?
Yeah. Price to cash flow relative to its 15-year history. And you can see that, tech is certainly stretched by pretty much all measures. And so, yeah, I think that, look, the nice thing about tech and AI is that these thematic, what we'll call productivity changing, transformational strategies, may not need 15 years to play out like the PC did or the internet did. Perhaps the adoption, because it's really just software in an installed base, perhaps we can really start to see some dislocations in the next couple of years. And I think that's what's really exciting investors nowadays.
That left side bar there for folks following along shows the tech with the yellow dot right where we are. So tip top of the valuation range. The other one that stands out like a sore thumb, of course, is the banks, the financials, where apparently no one wants to touch these stocks right now. What do you make of that? I mean, the fact that also energy, too, on the right side there shows pretty undervalued. The kind of core cyclical stuff It's interesting, those two look kind of similar because they traded the exact same way when the regional bank blow up happened. Investors traded energy down right alongside the regionals. Now energy's coming back, but the market is treating banks like a risk point for interest rates. What do you think about that, Jack? Is that the right way to consider it?
He's
I
AMC
think
almost
there are a couple of
40%
ways
today.
to look at the banks. Certainly
37%. They're
Fed's
not
gonna
subtle with their
be,
dilution.
they're tightening lending standards. They're requiring lower loan to values. That's going to put some pressure on commercial real estate. It's going to put some pressure on a lot of corporate borrowers. At the same time, this is a sector that's coming under a big regulatory scrutiny. I think, if you were to, ask a lot of the FDIC regulators off the record, would you prefer that we have 1,000 regional banks or look more like Canada with 6 mega banks? I think they would opt for Canada at this stage of the game.
Gotta say, it does kind of feel like it makes sense. As I've sort of half joked about before, you're driving through America and it's like every town has got a regional bank. It's pretty crazy. And, we kind of just accept it as a thing, but it doesn't necessarily have to be that way. Jack, when it comes down to what to do, it seems like you're a little bit leaning in the short term, more bear, pretty tough call. But it seems also you argue that maybe you don't have to trade it that way. You can just buy dividend stocks and hang patiently.
That's it. I think our theme for this year, and we're extending it into next year too, Oliver, is quality. The fact that, we see rising financing costs, and it's really creeping slowly. I think one of the things that, we had really worried about going into 2023 was this was going to be a year where, higher interest rates impacted fundamentals. Well, the fact is, if you look at these maturity walls, we're going to see $1 trillion of high yield bonds need to refinance, but it's over the next 5 years. We're going to see $2 trillion of commercial real estate refinance, but it's going to be over the next 2 years or so. So there's certainly going to be pressure points, and it's going to be more pressure on lower quality companies than higher quality companies. But this isn't something that, this higher interest rate is some baseball bat that's going to hit the side of the economy and throw us off our axis. This is something that will creep slowly. It'll be a quarter-to-quarter measure, one that will create headwinds, but one that shouldn't create a crisis.
Got it. Understood. Appreciate the intel as always, Jack. Good convo.
Thank you.
Thank you very much. Have a good one, sir. Jack Ablin, Crescent Capital. All right, let's trade some options when we come back. Got a lot of macro discussion there. Bringing in a little bit more focus. still functioning. Usually Rick's out of here by now.
I'm raring to go. I'm excited.
All right, let's do it. Let's talk some options here. GameStop ahead of earnings. What'd you say?
Well, GameStop, is an interesting one.
Oh,
here
it's just after the bell.
We've got a situation where we've got a stock that's
Might not have an earnings call.
significant fall from grace here. Earnings, and we've struggled with them for the past few years. They fired their CEO, their CFO resigned.
They didn't have
There's
one
a
last
lot
earnings,
going on in this
so don't
game,
expect an
and
earnings
they're
call.
also just facing a general shift into online retail, which is, just kind of a question mark.
We talked about the
But
chart this morning.
should get a filing after the
It's
bell.
at least coming into this on the lows, whereas
Within the
last
first,
time it
I'd
went
say
into earnings,
30
it was
minutes.
the high end of its range, and I think that kind of set it up for failure to some extent. What are they
I
trading?
don't have an opinion on the earnings.
Which direction?
This
They're
one
gonna
is a
beat
bit
or
of
miss?
a YOLO trade, honestly, Oliver.
Well, it's GameStop.
Yeah, you're buying puts. You're buying 1,673 September 8th, 16 strike puts at a 20-cent debit. So you can see that white line on the chart there. That was our strike price there. You can see that they're basically looking for it to make
Buy above VWAP there.
Yeah. Back down
Why are
to
we
the lows.
down to that trend
back down
line?
to the lows. And really, it's not impossible. The expected move for this option series is about $2.90.
What's
That
expected?
would put us right about at that level.
Market makers
of
expecting like
60 here. So
11%
they're looking
move.
for a bigger than expected move beyond that point.
Okay. That's pretty bearish.
Yeah,
but
definitely.
It's like very much within the realm of just where the stock has traded this year and around last earnings too.
It would be about a 16% drop to the downside here. Max profit, 2.6 million if it goes to zero. Not saying it will, of course, but that's just how this kind of thing works here. Total risk about 33 grand. So, a fun little way to blow that much money if it doesn't work out. But, if it does, you could profit pretty handsomely, excuse me.
Yeah, it's a low probability, high payout trade. YOLO, as you put it, just in the opposite direction of where they were YOLOing on this stock 3 years ago.
You see that shaded area on our risk profile, that's the expected range for this one. So it's pretty firmly at the max loss scenario. But like I said, if it does work out to be a bigger than expected move, it could pay off.
Okay. Well, not that they like being grouped together, but AMC's down 37%. So, I don't know, birds of a feather, something like that. All right, let's talk about Huntington Bank. Very dramatic switch there. But since we're talking financials and regionals, another soft day, and the company's down 2%. Did this just stand out by size or what? How come Huntington?
Well, when I do this segment, I look for trades that are outsized relative to their market here.
Okay.
And it was actually two trades that caught my eye. They were for the same strike price. They were at the same expiration. So the 11 strike puts, for the first trader sold 870 of them for a 47-cent credit. The second trader sold 712 of them for a 41-cent credit. So, maybe those aren't the biggest numbers you've ever heard or the biggest dollar amount. The max profit for our first trade is about $40,000. If you put them together, it's about $70,000. We don't know if it was the same person, but they were pretty close to each other.
They were twinning.
Yeah, exactly. But when you see a trade like this, it was 71% of the options market for this stock today. So you can see that
one of those or two of them combined.
The two of them combined.
Wow.
So I mean that's something that I like to look for is these outsized trades.
Yeah.
Maybe it's insider information. Someone is making a play on something they know about the company.
Sure.
Maybe it's just something whatever. It could be anything.
Well, I guess it's encouraging that it's.
Look at that. There's a green candle on AMC.
They want the stock to bounce. They don't want it to go down.
Insider buying and bullishness is always
Down
more
36%,
compelling
20 minutes to
bearishness,
go.
I think, because it suggests
AMC's climbing to VWAP.
something the company is doing. But the other interesting
Crazy.
thing about this trade today, we're actually below our strike price last time I checked here. So we're kind of already in trouble in this one here. So it's kind of a dicey situation. They've still got a good way to go before they're unprofitable. The break even comes in around, 1053. So about 3.4% to the downside. But it's
That's
not
like that could easily be a day the way the regional banks are going.
Exactly.
As far as trades collecting premium go, this is kind of a risky one because you're pretty much selling right below where we're already trading. Your strike is real close. You're kind of saying this sell-off's going to stop now.
We've already got assignment risk in this trade, so it's a dicey one, I thought here. That's why I thought it was interesting because on one hand, it's a safer type of trade. This is something where it's got cash secured puts are one of the least risky types of things, but at the same time, it's so close.
Yeah, exactly. So it's like taking on the most risk they can with this type of trade. Real fast, Southwest, you saw something bearish there. Stock is getting killed the last couple of weeks.
Actually, it's neutral to bullish in this one. We're selling puts again in this one.
All right, right around
minus
VWAP.
8,500, October 20th, 27.5 strike puts at a 31-cent credit here. So, you know, looking for a trade here that is, you know, more neutral to bullish, like I said. About 9.5% to the downside would be our break even in this name. So we can see that the reason for this one is they cut their outlook due to weakness in flight bookings.
Yeah.
So that's they're kind of worsening their estimates for the revenue for the upcoming year down a little bit. And this one is holding up okay, though. The trader executed this one after the initial pop in shares earlier in the day, so we're still doing pretty well with this one.
Okay. Another somewhat encouraging trade, selling downside, and hoping that the bleeding in Southwest stops somewhere around the lows of the year, roughly about 28 bucks. Nice trades, Rick. Good eyes. Thank you, sir, for sticking around late in the day. Long day for Mr. Ducat. Go pick up your kids, Rick. All right. Thanks. When we come back, we're going to get updates on a developing story from Jenny Horn on Alteryx. So we'll go back to the software space for a moment. Then we're going to do some trading with Dan Deming in the energy patch. Be right back.
All right, 15 minutes to close. 5 minutes to 10 minutes of Fugazi. Thanks, guys, for your likes. We're at 19 on the day. We'll do another stream for the earnings. And we'll end at close. Hold up another one. Ball. That dish is up 1.5. Little bounce on the low.
Check in here on the commodities disruption of our bull market from last week. Dan, what do you think?
Yeah, well, the production cuts certainly kept the momentum to the upside here, Oliver. They announced production cut extensions from OPEC Plus. And so, yeah, interesting dynamic when you look at the energy space as a whole. Now, the one thing that I was noticing is the disconnect between what's going on in WTI and what's going on with RBOB or gasoline as far as the price action. We're seeing RBOB higher today, but overall pretty much in the middle of the range for the last 6 weeks, yet we're still seeing WTI and crude in general breaking out to the highest levels in 10 months. So there is some dispersion within the various sectors of the energy space. But nonetheless, when you look at crude and particularly the formalized production extension cuts of being extended, Oliver, that certainly is continuing to maintain this upward momentum, and I think that there's still potentially further to go.
All right, what do you think is on the table here? What could be in the realm of possibility?
Well, I think that 90 is certainly the initial step higher from here, and that's that's about $2.50 higher. So, I think that could be the first kind of plateau area that we could see some resistance. I mean, certainly $100 isn't out of the question, but I guess it's going to be more contingent, I suppose, moving forward. Now that these production cuts have been extended and they're being priced into the market, how is demand going to, figure into this whole equation, and particularly demand coming from China? And that I think, will be the second determinant as to if we see further upside here in the next few weeks for WTI and crude in general. We see maybe some further initiatives coming out of China, something that will potentially shift the mentality or the psychology, I suppose, as to the pricing structure within the China economic structure. And, if there's going to be something there that could be a catalyst to seeing an increase in growth, or at least a stemming of some of the weakness that will potentially give crude another boost higher if those production cuts stay in place.
Yeah, nicely said. And the translation of crude oil into gasoline kind of seems like it's a little slow. Our Bob's been more muted, but should we expect that to track WTI eventually?
Typically, there is some, certainly they seem to work in tandem for the most part, and so I'd say that there's correlation there. But the one thing is that we're coming out of the summer driving season. Inventories here in the U.S., as far as I can tell, are still pretty much in line with where they are expected to be. And I think that the question will be, if we continue to see WTI and crude in general hold up at these elevated levels, that will slowly probably drag our Bob higher. But, currently, I think that just the dynamics of the supply and demand in RBOB are different than what we're seeing play out in the global crude space.
Okay, nice. And RBOB trying to catch up today, up about
a little
%
bit
next to it. Yeah. All right, WTI, maybe a float to 90 in the cards. Thank you, Dan.
All right, Oliver.
Nice look at the chart. Appreciate it. And the analysis, too. Dan Damian, KKM Financial. Let's talk some tech here with an update from Jenny Horn on a big rally in Alteryx. The software company trying to make a comeback after trading down into the lows. So what's the story here, Jenny?
Yeah, to speak to that, Oliver, we saw this name that's attempting to touch its 50-day simple moving average on today's nice move higher, but still a little bit off. And you can see it's been trending down for the last 200 days. This name is still down 32% on the year, even with today's nice move to the upside. So seeing some news today, we are getting a report of takeover interest. We saw it halted to the upside today on this news, but they're working with an investment bank amid the interest of this potential sale, according to reports we got earlier today from Reuters. Expressions of interest that this company has received so far have not met its valuation expectations, and the company could still, mind you, decide against a sale. They do have a market cap of around $2.2 billion with around 7% right now short interest. I heard you were just previously discussing a name that always has high short interest, that being GameStop. They have around 19, almost 20% short interest. So not quite meme stock level, but definitely nearing the upper side of the realm of all short interest in terms of the names we discuss. But we also are seeing right now they're valued, at least as far as a Truist analyst thinks, at around $44 a share. This is at about 3.5 times their revenue estimate for fiscal 2024. This implies a 26% upside from around current levels, according to this Truist analyst. This analyst does have a buy rating and a $40 price target on the stock, saying that following their recent earnings report, they believe actually the stock performance following these results and execution challenges creates a potentially attractive situation for activist investors or private equity firms. So that's, to me, an interesting perspective. Perhaps we could get some more clarity on this news, though, when this company does have a presentation at Citi's 2023 Global Technology Conference this Friday. So right now, haven't gotten any word back from the company, but obviously seeing some credibility to these rumored takeovers, just given the nice 14% move higher we've seen today.
Hey, no surprise in my framework of thinking about these high growth software companies that peaked out and now have been crashing, because the businesses and the products all still very viable and solid and customers seem to like it. But from a stock perspective, I mean, the whole theme has totally reversed. So takeover targets galore, I would think, across the sector. I'm surprised we haven't heard more. So keep tabs on it for us. Thank you very much, Jenny, host of Next Gen Investing. Coming back, get our Schwab team in here to close out the session. Stocks are trying to grind it out. But Apple down 4%, going to make it a very tough grind for the NASDAQ, still 1% away, but off the lows.
All right, 10 minutes for Gazi. Here we are. All right, 5-minute finger slap coming up. Top down 2.8% for the earnings. 1870. Barbecue. 6 1/4. Low. I don't want to see barbecue. 4. %6 down on AMC. Alright, I'm going to cut off now and make another stream for the GME earnings call. Thanks guys for support today. Wednesday. Not a bad Wednesday. Pretty good price action on SPY. Didn't trade it quite. My best entry, I walked away. Thought setting up and I had to step away. It was right here. Nice entry to the short. Of course I could have just held the double top, but whatever. This would have been my next realistic entry. called the reversal too soon, and then called it nicely on the secondary count. But SPY's down 0.72, ending at BWAP. Thanks for your likes, guys. 20 likes on the board. Appreciate it. We'll see you on the GME earning stream, which I will start up right